Please like, share, and subscribe. Wishing you happiness and good luck every day.
You know that feeling? The one that tells you if you could just find that one hot stock, that one hidden gem, you could make a fortune. We've all been there. Well, that feeling is one side of this giant tug of war that pretty much defines Wall Street. But on the other side, there's a much simpler idea. It's an idea that, as all the evidence shows, is way more likely to build real, lasting wealth. So today, we're going to pull back that curtain, look at this fundamental conflict, and figure out which side you really want to be on.
All right, so here's our roadmap. First, we're going to break down the two big, competing philosophies that drive the entire market. Then, we'll take a bit of a wild ride through history to see what happens when the crowd just takes over. That's going to lead us to a really critical question. Can the pros, the so-called experts, actually win this game for you? The answer, you'll see, reveals a surprising truth about randomness. And that sets the stage for the most important part. 3 simple, giant steps you can take to build your own wealth. Finally, we'll wrap it all up and talk about how to play the winner's game.
Okay, let's get right to the heart of it. Almost every single investment decision you could possibly make comes down to a choice between two powerful and totally opposite ideas. Understanding this conflict, well, it's the key to everything else we're going to talk about.
So, on one side, you've got what's called the firm foundation theory. Think of this like old-school detective work. The idea is that every single stock has a real, solid, intrinsic value. You can figure it out by digging into the numbers, the earnings, the assets, the balance sheet. Your job is to be the smart analyst, find that true value, and buy the stock for less. But then you have the castle in the air theory. This one says, forget the spreadsheets. A stock is only worth whatever someone else is willing to pay for it tomorrow. Your job isn't to be an analyst. It's to be a psychologist, trying to guess what crazy, beautiful castle the crowd is going to build next, so you can buy in now and sell to them later at the top.
You know, the famous economist John Maynard Keynes had the perfect analogy for this. He said, it's like one of those old newspaper beauty contests. To win, you don't pick the face that you think is the prettiest. No, the winning move is to pick the face that you think everybody else is going to think is the prettiest. Just let that sink in for a second. Your own judgment, what you actually think, it's totally irrelevant. It's a game of guessing what the crowd is going to do next.
So what happens when an entire market just starts building these castles in the air? Well, history gives us some pretty spectacular and, frankly, painful examples. Let's take a look at what happens when crowd psychology completely disconnects from any sense of reality. I mean, the pattern is so consistent, it's almost funny. You go back to the 1630s, and people were paying more for a single tulip bulb than for an entire house. A tulip. Then, in the 1700s, you had the South Sea Bubble, where a company's stock soared based on pure fantasy about trade. In the 1960s, it was the soaring 60s, and of course, many of us remember the dot-com bubble, right? Companies with no profits, sometimes no revenue, were suddenly worth billions. In every single one of these cases, the asset is different, but the story is exactly the same. The castle gets built higher and higher on nothing but hope and hype, with absolutely no firm foundation to stand on.
This quote from way back in 1895, it just nails it, doesn't it? While these speculative bubbles feel amazing on the way up, and they can last a surprisingly long time, history has a perfect, undefeated record. They always pop. The financial law of gravity is undefeated. What goes up on pure hype must come down. The lesson here is pretty simple. Trying to time this game is just playing with fire.
All right, so if building castles in the air is a loser's game, then the obvious conclusion is that the smart money, the pros doing all that firm foundation detective work, they must be the ones who win, right? I mean, they've got the huge teams, all the data, the fancy degrees. They should be able to consistently beat the market for their clients. It just makes sense, doesn't it? Well, let's actually put that theory to the test. The data might just surprise you. This really is the multi-trillion-dollar question, isn't it? There's an entire industry built on this single promise, that a highly paid professional can deliver better returns for you than you could get on your own. But does their performance actually live up to the hype and the fees they charge? Let's stop guessing and look at the cold, hard numbers. Wow. Okay, this chart just cuts through all the noise, all the marketing, all the sales pitches. Just picture 2 investors. It's 1977, and they each have $10,000. Investor A does something really simple, almost boring. They just buy a fund that owns the entire market, an index fund, and they go live their life. Investor B, on the other hand, hires the pros. They put their money into the average, actively managed fund. Now, fast forward 45 years, look at that. The difference is it's absolutely breathtaking.
Over $666,000. That's not a typo. That is, for all intents and purposes, the cost of active management. It's the price the average investor paid for trying to beat the market and failing. And the data shows that is the most likely outcome over the long run. We're talking about a life-changing amount of money just left on the table.
And hey, if that data somehow isn't convincing enough, just listen to this. This is a quote from Benjamin Graham. This is the guy who literally wrote the textbook on security analysis. He was Warren Buffett's mentor. He was the intellectual father of the entire firm foundation theory. And at the end of his life, even he admitted that the game had changed. He said that trying to outanalyze the market just wasn't a winning strategy anymore. When the grandmaster of the game himself says it's over, we should probably listen.
So what is going on here? If the speculators chasing bubbles lose and even the smartest analysts on the planet can't consistently win, what gives? Why is the market so incredibly hard to beat? Well, the answer is in this powerful and honestly kind of counterintuitive idea about how markets really work.
It's a big-sounding name, the efficient market hypothesis, but it's actually a lot simpler than it sounds. It basically says that the stock market is this unbelievably fast, powerful information processing machine. It takes every single piece of public information, every news story, every earnings report, every whisper and rumor, and almost instantly it bakes that information into the current price of a stock.
And here is the really mind-bending part. That random walk that stock prices seem to take, that daily up and down zigzagging, that isn't a sign that the market is irrational or crazy. It's actually a sign that the market is working so well, so efficiently, that the only thing left to move prices is new, totally unpredictable information. And by definition, you can't predict the unpredictable. So if the market has already priced in everything you know, how can you possibly beat it?
Okay, I know that might all sound a little bit discouraging. We've just said that chasing hot trends is a bad idea and trying to outsmart the market is a fool's errand for most of us. But it's not bleak at all. In fact, it's liberating. Because once you accept this reality, you can step off that hamster wheel and embrace a simple, powerful, and proven path forward. So let's do it. Let's walk through the 3 giant steps to playing a true winner's game.
First up is what we can call the no-brainer step. Stop looking for the needle in the haystack. Just buy the whole haystack. Own the entire market through broad, low-cost index funds. Second, you have to know yourself. Your investments should line up with your ability and your willingness to take risks. That's going to be very different for a 25-year-old just starting out than for someone who's getting close to retirement. And third, and this might be the most important one of all, is just save. The amount you put away consistently, automatically, month after month, will probably have a bigger impact on your final wealth than any brilliant investment pick you could ever make.
And would you just look at how incredibly easy step 1 is these days? I mean, with a single click of a button, you can buy a tiny piece of the entire US stock market or even the whole world stock market. And the best part? Look at those costs, an expense ratio of 0.03%. That means you're paying just 30 cents a year for every $1,000 you invest. It is practically free. This is the simple, powerful tool that makes owning the entire haystack not just possible, but ridiculously easy. So, let's bring this all home. We've busted the myths of trying to time the market and pick the winning stocks, and we've laid out a simple, powerful strategy. But the last piece of this puzzle, it isn't some fancy tactic or a secret formula. It's about a fundamental shift in your mindset. It's about making a choice to stop playing a loser's game and start playing a winner's game. And this quote, it really gets to the heart of why any of this matters. Burton Malkiel, the author of the legendary book that inspired this whole explainer, says his greatest joy isn't from being right about the market. It's from hearing from regular people who took this simple advice, save your money, buy the index, and used it to build real wealth, to achieve a secure and worry-free retirement. This isn't just some abstract theory. It's a proven, real-world path to financial freedom. So, at the end of the day, it all comes down to this one simple question. Are you going to keep spending your time, your money, and your emotional energy constantly searching for that one magic needle? Or are you going to play the proven winner's game and just buy the whole haystack? The evidence couldn't be clearer. The choice is yours. All right, welcome. Today we're taking a walk down Wall Street to get to the bottom of one of its oldest, most important debates. And really, it all boils down to one simple question. When you buy a stock, what are you actually buying? Are you buying a little piece of a business? Or are you just buying a ticket in what's basically a popularity contest?
I'm telling you, getting that answer right, well, that's the difference between winning and losing in this game. So let's dive in.
You know, Oscar Wilde wrote this more than 100 years ago, but it is amazing how perfectly it captures the central battle raging on Wall Street today. There's this constant tug of war between the price of something, what you have to pay for it, and its true underlying value. And believe me, understanding that difference, that's the key to absolutely everything.
So you look at the market today, you hear about these super fast trading algorithms, giant hedge funds, and all these complex schemes, and it's easy to think, what chance do I possibly have? Well, I'm here to tell you, the truth is, you absolutely stand a chance. In fact, you can do just as well as the so-called experts, maybe even better. How? It's all about understanding the fundamental game that's being played.
Okay, so here's our roadmap for today. First up, we're going to ask, can you really beat the pros? Then we'll get into this really controversial idea called the random walk. From there, we're going to explore the two big rival theories for valuing stocks. You've got the logical, firm foundations on one side and the psychological castles in the air on the other. And finally, we'll ask the big question, which one really drives the market?
It might sound a little crazy, but individual investors like you and me, we often have an edge. I mean, think about it. While the professionals were getting completely wiped out in 2008, buying these complex things they didn't even understand, or piling into crazy overpriced tech stocks back in 2000, it was often the steady individual investors who just kept their heads, and they came out on top. Your greatest advantage isn't a fancy algorithm, it's your own temperament.
Now, before we go any further, let's be crystal clear about what we're talking about today. We are talking about investing. That's the long-term game. This isn't about day trading, it's not about gambling on short-term whims or trying to get rich overnight. This is about the get rich slowly but surely approach, building real wealth over years and decades.
And why does that long-term view matter so much? Well, because of the silent killer of your savings, inflation. I mean, just look at these numbers. Between 1962 and 2021, the price of a newspaper jumped almost 6,000%. A simple Hershey bar got 20 times more expensive. The lesson here is so clear. If your money isn't growing, it's actually shrinking. Investing isn't just a way to get rich, it's a necessity so you don't get poor.
Okay, now let's get to the idea that basically set Wall Street on fire. It came out of academia, and let me tell you, the pros saw it as a direct attack on their entire profession. It's called the random walk theory, and it kicked off a huge battle that is, believe it or not, still raging today.
So what exactly is a random walk? Well, it's the theory that in the short run, stock price movements are completely and totally unpredictable. Now think about what that means. If that's true, then all those expert forecasts, all those fancy newsletters you see, all those complicated chart patterns, they're basically useless for predicting the next move. It's a direct challenge to the entire industry of professional stock picking.
And this is the part that got Wall Street so upset. The academics took the theory to its logical extreme. They said a blindfolded monkey throwing darts at a stock page could, in theory, pick a portfolio that would perform just as well as one chosen by a highly paid expert analyst. As you can imagine, the pros in their pinstripe suits didn't exactly appreciate that comparison.
You see, this whole debate over whether the market is predictable or random forces every single investor to pick a side. Because if it's not totally random, how do you find your edge? And that leads us to these two great rival theories. On one side, you have the firm foundation school. They believe in cold, hard numbers, calculating a stock's true value. On the other side, you have the castle in the air school. And they argue it's all about psychology. It's about predicting what the crowd will do next.
So let's start with the firm foundation theory. This is the analytical, methodical, almost scientific approach. It argues that every single investment, a stock, a bond, a piece of real estate, has a true, measurable, intrinsic value, and the investor's job is simply to figure out what that is.
So how does it work? Well, it's basically a three-step process. First, you have to try and forecast all the future cash a company is going to generate. Second, and this is the really key part, you discount that future money back to today. Think of it this way. A promise of $1 a year from now is worth less than having $1 in your hand right now. Discounting is just the math to figure out exactly how much less. Then finally, you compare that intrinsic value you calculated to today's stock price. If the price is lower than your value, you buy. Simple, right? The whole thing just hinges on one very, very big if. If you can accurately predict the future. Now, this isn't just some dusty old academic theory. This was pioneered by Benjamin Graham and David Dodd, and their book literally became the Bible for a whole generation of Wall Street analysts. And its most famous and by far most successful practitioner,
A guy you might have heard of, named Warren Buffett. He built his entire fortune on this exact principle, proving that if you have immense discipline and patience, you really can find great companies trading for less than they're actually worth.
But there is a completely different way to look at the market. This is the castle in the air theory. And its greatest champion was the brilliant economist, and as it turns out, a remarkably successful investor himself, John Maynard Keynes. For Keynes, investing wasn't about spreadsheets and calculators. It was all about psychology.
Keynes's logic here is just so powerful. He's basically saying, who cares if your fancy analysis shows a stock is worth $30 if you know the market is about to get pessimistic and drive the price down to 20? In the short term, what the crowd thinks the stock is worth is way more important than what its true value might be. The goal isn't to calculate value, it's to anticipate the crowd.
He explained this with a brilliant analogy about a newspaper beauty contest back in his day. To win, you don't pick the faces that you personally find the most beautiful. That's level 1 thinking, and you're definitely going to lose. Level 2 thinking is to pick the faces you think most other people will choose. But the real pros, they operate on level 3. They try to guess what the average opinion will be about what the average opinion will be. It's a game of getting inside the mind of the market several steps ahead of everyone else.
Now, a less charitable name for this, but maybe a more direct one, is the greater fool's theory. The idea is that it's perfectly fine to knowingly overpay for something as long as you are confident that you can find an even greater fool to buy it from you at an even higher price later on. In this world, value is totally irrelevant. Momentum is everything. So, which theory is right? Does the market follow these firm foundations of value, or is it just a series of beautiful castles in the air built on human emotion? Well, you know what they say, history doesn't repeat, but it often rhymes, and it gives us some pretty dramatic clues. Just take a look at this timeline. From tulip bulbs in the 1600s all the way to meme stocks and crypto in our own time, history is absolutely littered with these speculative bubbles where prices became completely unhinged from any underlying value. These are pure castles in the air. People weren't buying because of some calculation of intrinsic worth. They were buying because the price was going up and they thought they could sell to a greater fool tomorrow. And you know how every single one of these stories ends? They came crashing down.
There's this ancient Latin saying that just perfectly sums up the entire castle in the air philosophy. Rest tantum valet quantum vendis potest. It means a thing is worth only what someone else will pay for it. It suggests that value isn't some objective number you can find in a spreadsheet, but a subjective, fleeting agreement between a buyer and a seller at one specific moment in time.
And all of this leaves us with the ultimate question for every single one of us who invests. When you put your money down, what are you really betting on? Are you betting on a solid, calculable foundation of intrinsic value, like Warren Buffett? Or are you trying to read the psychology of the crowd and get out before that beautiful castle in the air comes crashing down? The answer to that question, well, that defines exactly what kind of investor you are. You know, what if I told you that a single flower, just a flower, could bring an entire nation to the brink of collapse? Or that one of the absolute smartest people in all of human history lost a fortune on a company that literally had no business plan? No, this isn't fiction. This is the real story of speculative manias. That strange, powerful, and kind of terrifying urge that can grip an entire society and turn perfectly sensible people into wild gamblers. And believe me, it's a story that is more relevant today than it has ever been. Mark Twain, of course, just nails it. He's basically saying that the temptation to roll the dice, to get in on the action, it's always there. It's a dangerous game, and as history shows us over and over again, it can turn from a so-called calculated risk into a collective madness, where the crowd itself, well, the crowd becomes the master. You see, at the heart of any market, there are really two big competing ideas. First, you've got the firm foundation theory. This says an investment's value is based on something real. You know, its earnings, its assets, solid stuff. But then there's the castles in the air theory, which is way more exciting. This isn't about real value at all. It's about pure psychology. It's the belief that something is worth whatever the next person is willing to pay for it. And to really get how these castles get built and why they always come crashing down, we're going to look at three of the biggest examples in history. Okay, so for our first stop, we're heading back to the 17th century Netherlands. Now, this was a nation known for being sensible, prudent, thrifty. It's probably the last place on earth you'd expect a full-blown financial mania to break out.
And yet, this is where a simple, beautiful flower, just recently brought over from Turkey, would become the focus of an obsession so completely intense it threatened to tear their entire economy apart. Just look at this timeline. You can see how fast the fever spread. It all starts out pretty innocently, but then a weird quirk of nature, a virus that actually created these stunning, unique patterns on the petals, turns certain tulip bulbs into these ultra-rare status symbols. By 1634, it's not even about the flowers anymore. It's pure speculation. And look at this. In just 1 month, January 1637, prices explode 20 times over. 20-fold. Fortunes were being made in a matter of days. But then, just a month later, the castle in the air collapses. Panic hits, and all that money vanishes even faster than it appeared.
And this wasn't just some game for the rich and powerful. No way. This mania infected every single level of society. As one writer at the time put it, regular work was just abandoned. I mean, can you imagine? You're a farmer and you see your neighbor, a chimney sweep, suddenly getting fabulously wealthy off a flower bulb. The belief that prices could only go up became an article of faith. The fear of being the only one not getting rich was just too much to handle.
So you're probably wondering, how could a chimney sweep afford a single bulb that cost more than a house? Well, they used a brand new financial toy, the call option. Think of it this way. It's like putting a small deposit down on a house. You pay just a tiny fraction of the price to lock in your right to buy it later. Now, if that house's value doubles, your tiny little deposit has just secured you this massive profit. This leverage, it was like pouring gasoline on a bonfire. It made the potential gains insane, but it also meant that when the market finally turned, people lost everything.
And this little story just perfectly captures the complete and utter absurdity of it all. So get this, a visiting sailor who has no idea what's going on sees what he thinks is an onion. He grabs this priceless bulb and casually eats it for a snack. For this, he gets thrown in jail. It's a funny story, but it's also tragic. And it just shows how completely disconnected the prices have become from any kind of real-world value.
So if Tulip Mania was a story of a kind of collective delusion, our next story, about a century later in England, adds a much more sinister ingredient to the mix. Here, the frenzy wasn't just some spontaneous craze. It was carefully, deliberately engineered by fraud on a colossal scale. Welcome, my friends, to the South Sea Bubble.
The engine that drove this whole thing has a name, the Greater Fool Theory. It's basically a high-stakes game of musical chairs. The crazy part is, investors knew the companies they were buying into were worthless. They didn't care. Their entire strategy was to buy high and then sell even higher to somebody else, a greater fool, before the music stopped. In their minds, this wasn't madness at all. It was a perfectly rational plan.
The South Sea Company's plan was just a masterclass in manipulation. Step 1, you get a monopoly on trade with South America, even though you have 0 ships and 0 experience. Step 2, you make this grand, patriotic-sounding offer to buy up the entire national debt. Step 3, you bribe politicians and even the king's mistress with free stock to make sure the deal gets approved. And then the final, brilliant move, you sell shares to the public on an easy installment plan, so literally anyone can get in on the action. It was irresistible.
And the result of all this? Well, this chart says everything. The stock price didn't just climb, it went vertical. It starts the year at £130. It more than doubles by April after Parliament gives them the green light. By August, it's trading at nearly £1,000 a share. The public was in an absolute state of delirium.
This frenzy around the South Sea Company sparked a whole cottage industry of copycat scams. And the business ideas were just breathtakingly absurd. People were lining up around the block to invest in companies that promised to trade in human hair, or to build a hospital for illegitimate children, or even a scheme for extracting sunlight from cucumbers. But my personal favorite, a wheel of perpetual motion.
But the absolute peak of this madness, the grand prize for sheer audacity, has to be this one. A guy offered shares in a company for a secret but very profitable venture. He didn't even bother to make up a fake business plan. And the public, so desperate to invest in anything, literally broke down his door to give him their money. Within 5 hours, he'd collected all the cash, closed up shop, and sailed away, never to be seen again. And just in case you think this was only for the gullible and the foolish, consider this: Sir Isaac Newton, the genius who discovered gravity, one of the smartest minds ever to live. He lost a fortune, the equivalent of millions and millions of dollars today. His famous quote really says it all: "I can calculate the motions of heavenly bodies, but not the madness of people."
It's a pretty humbling reminder that when the herd is stampeding, even the smartest person in the room can get trampled.
All right, for our final story, let's leap forward into the 20th century, to the land of limitless opportunity, America. It's the roaring 20s. The economy is absolutely booming, optimism is infectious, and everybody believes they have a right to be rich. It was the perfect storm, the perfect environment for building the biggest, most spectacular castle in the air the world had ever seen.
This whole boom was built on a foundation of pure manipulation. You had these powerful traders who formed what they called investment pools just to rig the game. Here's the playbook. First, they'd secretly buy up tons of a single stock. Then, they'd create fake buzz by trading shares back and forth among themselves. This was called painting the tape, so it looked like there was huge interest. They'd pay off journalists to plant glowing stories, and then, once the public, drawn in by all the hype, started buying like crazy, the pool would quietly dump all their shares, making a fortune and leaving everybody else holding the bag.
And just as the market was hitting its absolute peak, the so-called experts gave everyone cover. Just days before the crash, the famous Yale economist Irving Fisher declared that stocks had reached a permanently high plateau. He actually argued the new technologies and, weirdly, prohibition had made American workers so productive that these sky-high prices were totally justified. Famous last words, right? He could not have been more wrong.
And this is what that permanently high plateau actually looked like. It wasn't a plateau, it was a cliff. And we're not talking about some risky penny stocks here. These were the giants of American industry, the bluest of blue chips. U.S. Steel down over 90%. And RCA, the big tech darling of its day, was basically wiped off the map, down 97.5%. Life savings that took decades to build just vanished. No one really captured the moment better than the entertainment newspaper Variety. With this blunt, almost comical headline, it somehow managed to perfectly summarize the shock and the sheer absurdity of the country's financial collapse. The party was officially and spectacularly over. So, from a Dutch flower in the 1600s to an English trading company in the 1700s, all the way to the American stock market in the 1900s, the details are different, but the story feels disturbingly familiar, doesn't it? Which brings us to the most important question of all. Why? Why do we keep doing this to ourselves?
Well, as you can see, the DNA of a bubble is remarkably consistent over the centuries. It always kicks off with good old-fashioned greed and our powerful herd instinct, that primal fear of missing out. Then you have new financial technologies, whether it's call options for tulips or commission-free trading apps today, that just pour fuel on the fire. The whole thing is held together by the greater fool theory. And the ending, without fail, is always the same: a crash. So here's the fundamental lesson in all of this. The four most dangerous words in investing are, this time is different. History shows us again and again and again that markets built on nothing but hope and psychology, on the belief that there will always be a greater fool, they cannot defy gravity forever. Eventually, reality always comes knocking. The names are always changing. Tulip bulbs, South Sea stock, dot-coms, you name it. But the human emotions, the greed, the fear, the madness of crowds, they stay exactly the same. Mark Twain also said that history doesn't repeat itself, but it often rhymes. So the only question left to ask is, when you look at the world today, where do you hear the rhymes? All right, today we're diving into Burton Malkiel's classic, A Random Walk Down Wall Street. And we're looking at some of the most absolutely wild market bubbles in history. We're going to see how even the sharpest minds on Wall Street can get completely swept away by pure, unadulterated madness. You know, we've all heard the stories. Tulip bulbs, the South Sea bubble. It's easy for us to sit back and write that off as, the madness of the crowd. But what happens when it's the professionals? The folks with the fancy degrees and the sharp pencils? What happens when they're the ones driving the frenzy? Surely the big institutions are above all that nonsense, right? And look, this isn't just some small academic question. Think about this. By the 1990s, these institutional investors were responsible for over 90% of all trading on the New York Stock Exchange. So when they get caught up in a bubble, the stakes are massive for every single one of us. So let's take a look at just how sane they've really been. Okay, our tour is going to start in the 1960s. This was a decade where one single word held an almost mystical power over investors, and that word was growth. The whole idea was pretty simple. You buy a growth stock, and you could be sure that some greater fool would come along and buy it from you later for an even crazier price. This mindset basically set the stage for two unbelievable manias. So first up was the Tronics boom. In the early part of the 60s, investors had this absolutely insatiable appetite for anything that sounded futuristic or, space age. It didn't matter what your company actually did. If you could just slap a name on it that had electronics in it, you were golden.
The financier Jack Dreyfus just summed up the absurdity of it all perfectly with this quote. He joked that you could take some sleepy old shoelace company, rename it something nobody could even understand, like electronics and silicon firth burners, and just sit back and watch the stock price double. The most incredible part? He wasn't really joking.
I mean, check out this real-world example. American Music Guild. Their business? Selling records door to door. A perfectly fine business, but not exactly exciting. So what did they do? They simply changed their name to Space Tone, took the company public, and the stock shot up from $2 to $14 a share in a matter of weeks. Nothing about the business changed, just the name.
Now, you're probably thinking, okay, where were the regulators in all this? Where was the SEC? And oh, they were there. They forced these companies to put these giant, bold warnings right on the front of their prospectuses. Stuff like, this company has no assets or earnings, the shares are highly risky. But it didn't make a bit of difference. It was like the warnings on cigarette packs. The speculators just didn't care. They were absolutely convinced they had a winning lottery ticket.
So after the whole tronics boom finally fizzled out, Wall Street needed a new story to sell. And that new product was a fancy word, synergism. This was this magical concept that if you merged two companies, the new combined company would somehow be worth more than the two parts separately. 2 + 2 = 5. This idea gave birth to the conglomerate, a company that just went around buying businesses in totally unrelated fields.
Now, here's the crucial thing to get. This wasn't really about making businesses run better, it was all about financial engineering, a kind of accounting trick. Let me walk you through how this game was played. Imagine you've got a hot tech company. We'll call it Able Circuit. The market loves it, so it trades at a high price-to-earnings multiple, maybe 20 times, because, tech is sexy. And it wants to grow.
So Able Circuit goes looking for a target, and it finds one, Baker Candy, a boring but profitable little company that the market doesn't care about, so it trades at a low multiple of, say, 10. Able Circuit then uses its own high-priced stock to buy Baker Candy. And here's the magic trick. The market suddenly sees Able's earnings jump up because it just absorbed all of Baker's profits. But, and this is the key, the market keeps valuing the entire company, Candy profits and all, at that high-tech multiple. And just like that, poof, you've manufactured earnings per share growth out of thin air.
And this wasn't some fantasy scenario. Real companies, like Automatic Sprinkler, played this game to perfection. They just kept buying company after company. And the market, it rewarded this fake growth by bidding its stock up to a truly mind-boggling price-to-earnings multiple of over 50.
But the party always has to end. And in 1968, the music stopped. Litton Industries, which was the granddaddy of all these conglomerates, suddenly announced it was going to miss its earnings forecast. And just like that, the magic was gone. Regulators started sniffing around, those fat premium multiples just vanished, and the whole house of cards came tumbling down.
Now, after getting absolutely burned by all the speculative nonsense of the 60s, the professionals on Wall Street swore they were going to be more careful in the 1970s. They decided to turn to safe blue-chip stocks. But in their rush for safety, they ended up creating a brand new and maybe even more dangerous bubble, the Nifty 50.
So these were the premier can't-miss companies of the day. We're talking IBM, Xerox, Polaroid, Disney, the giants. The whole theory was that these companies were such proven winners that you only had to make one decision, just to buy them. Then you could just hold them forever. You didn't even need to worry about the price you paid because their amazing growth would eventually justify any valuation.
So how safe were they really? Well, at the very peak of the mania, these so-called safe companies like McDonald's and Disney were trading at price-to-earnings ratios of over 80. 80. To justify that kind of price, they would have needed to grow at completely impossible rates for decades. The professionals had built another castle in the air, only this time they used blue-chip bricks. And you know what happened? It crashed. Again.
You would think the lessons would finally stick, but nope. The 1980s came along and proved that on Wall Street, financial memory is painfully short. The decade gave us an almost perfect repeat of the 60s new issue craze, and that was followed by one of the most unbelievable fraud cases Wall Street has ever seen.
Yep, in 1983, the market just went wild for initial public offerings again. And the quality of these companies, well, let's just say it was a little questionable. You had restaurant chains with names like Stuff Your Face, companies that were planning to sell personal robots, and even an IPO from Muhammad Ali Arcades International. It was just a total circus, and a lot of investors got stung. Badly.
But the story that really defined the 80s bubble has to be Barry Minkow and his company ZZZZ Best Carpet Cleaning. I mean, this story is just incredible. You have a kid who starts a business in his parents' garage at 15. By 18, he's a millionaire. He's on Oprah being called a boy genius. He promised everyone he was going to build the General Motors of carpet cleaning.
The only problem? The whole thing was a massive fraud. A giant Ponzi scheme that was basically being used to launder money for the mob. That spectacular growth was completely made up. At a sentencing, the judge told the then 23-year-old Minkow, "You are dangerous because you have this gift of gab. You don't have a conscience." It was just a stunning end to a story that the big institutions had bought hook, line, and sinker.
So what's the common thread running through all this madness? Well, the lessons are pretty clear. Fads and fashions dominate the market, new public offerings are incredibly risky, and the so-called professionals are just as susceptible to hype as anyone else. And to see these exact forces play out on a truly global and catastrophic scale, we have to turn our attention to Japan.
In the late 1980s, Japan didn't just have a boom, it had an explosion of epic proportions. At its absolute peak, Japanese real estate was valued at nearly $20 trillion. That's 20% of the entire world's wealth, and its stock market accounted for a staggering 45% of global stock market value. It's almost impossible to comprehend.
And the valuations were just completely disconnected from reality. While stocks in the US were trading for around 15 times their earnings, Japanese stocks were trading for over 60 times earnings. And everyone kept saying, "Oh, Japan is different. The old rules don't apply here." Well, it turns out they were wrong.
Because, as this quote says, the financial laws of gravity are universal. In 1990, the Bank of Japan raised interest rates just a little bit, and Isaac Newton showed up. The bubble didn't just ease down, it collapsed. The Nikkei stock index fell over 60%, wiping out trillions in value and kicking off decades of economic stagnation.
So, from the Tronics boom and the Nifty 50, all the way to the epic collapse in Japan, history teaches us a pretty clear lesson. It doesn't matter how smart the players think they are. Markets are driven by hope and by hype. And bubbles, fueled by that hype, always burst. Always. The only real question left is, what's going to be the next one?
Today, we're going to dive into the financial manias that have really defined our century so far. You know, from the incredible promise of world-changing tech to the rock-solid safety of real estate on Main Street, we have seen speculation create massive fortunes and then, just in a flash, wipe them all out. So let's dig into this predictable and frankly devastating pattern of boom and bust. You know, Kipling's words here, they get right to the heart of the problem for any investor, right? When it feels like every single person you know is getting rich off of assets that seem to defy all logic. How do you keep your cool? How do you fight that incredible pull to just jump in and join the herd? That one question, that is the engine at the center of every single financial bubble.
And believe me, the stakes are absolutely staggering. This number you're looking at, $8 trillion, that's the amount of wealth that just evaporated when the first great bubble of our century, the dot-com bubble, finally burst. To put that into perspective for you, that's like the entire yearly economic output of Germany, France, and the UK, all at once, just vanishing into thin air.
Okay, so here's our game plan. First, we are going to dissect the engine that powers every single bubble. Then we'll walk through 3 really distinct case studies, the dot-com mania, then the housing crash that almost broke the entire world, and of course the recent social media-fueled frenzy in meme stocks and crypto. And finally, we're going to ask the big one. What's the lesson that we just keep failing to learn?
All right, let's start with the basics. Before we look at any specific craziness, we've got to understand the engine that makes it all go. What exactly is a bubble? How does one even start? Well, it turns out there's a predictable, almost mechanical process at work here. So at the very core of every bubble is this idea from the economist Robert Shiller, the positive feedback loop. It all starts pretty simply. Prices for something, anything, start to go up. This catches people's attention, so more people start buying. The media then jumps on the story, which attracts an even bigger crowd, which, you guessed it, pushes prices even higher. It basically becomes this naturally occurring Ponzi scheme, where the whole thing relies on finding an endless supply of greater fools who are willing to buy at the very top.
And you can see exactly how this thing spirals out of control. That initial price jump creates these stories of easy money that make everyone else feel like they're missing out. This triggers a powerful fear, FOMO, pulling in bigger and bigger crowds. The cycle just feeds on its own momentum, growing more and more intense, until that final, inevitable moment, when the supply of new buyers just dries up. And that's when the whole house of cards collapses under its own weight.
So let's see this engine in action with our first case study, the dot-com boom. Now, this bubble was fueled by a technology that was genuinely world-changing. The promise of the internet was so huge that it convinced millions of people that the old rules, things like profits and earnings, they just didn't apply anymore. The four most dangerous words in investing became everyone's favorite mantra: this time is different.
I mean, the signs of total insanity were everywhere. The NASDAQ more than tripled in just 2 years. Good, profitable companies were trading at over 100 times their earnings. The whole thing got so ridiculous that just adding .com to your company's name could make your stock price explode, even if your business had nothing to do with the internet. And the startups? Oh man, billions were poured into ideas like DigiSense, a company that promised to let you smell websites. I'm not kidding.
If you need just one story to really grasp how completely disconnected from reality the market got, this is the one. So 3Com, a profitable tech company, decided to spin off its subsidiary, Palm, which made the super popular Palm Pilot. The market went so crazy for the hot new thing that Palm's valuation ballooned to become twice the size of its own parent company. Now, just think about that for a second. Since 3Com still owned almost all of Palm, the market was basically saying that all of 3Com's other profitable businesses were worth less than zero, negative $25 billion to be exact. It was a complete and total breakdown of basic math.
And who was fanning these flames? Well, Wall Street's own celebrity analysts. People like Mary Meeker and Henry Blodgett became superstars on TV, telling everyone that the old ways of valuing companies were dead, and that it was a time to be rationally reckless. Their glowing buy ratings were like pouring gasoline on the fire, convincing the public to pile in, all while helping their own banks secure massive investment banking fees from those exact same tech companies.
So how on earth did they justify these insane prices for companies that had no profits, sometimes not even any sales? Simple. They just invented new metrics. Instead of earnings, they talked about eyeballs, as in how many people visited a website, or mind share, how much time people spent there. It didn't matter if those visitors ever actually bought a single thing. These were just justifications built on hot air to support stock prices built on pure hype. Next, let's turn to a bubble that was, in a lot of ways, even more devastating. See, the dot-com crash wiped out stock portfolios, sure, but the housing bubble struck right at the heart of the American dream, your family's home, and this time, the fallout was going to spill way beyond Wall Street. Now, to really understand the housing bubble, you have to get this one critical shift in how banking worked. For decades, the model was originate and hold. A bank gave you a loan. They kept it on their books, which meant they had every reason to make sure you could actually pay it back. But that all changed to originate and distribute. Now, banks made loans and immediately sold them off to Wall Street to be chopped up and packaged into these complex bonds. All of a sudden, the original lender didn't care if the borrower could pay. Their risk was gone in a matter of days. And this new model led directly to this masterpiece, the ninja loan. It literally stands for no income, no job, and no assets. Yes, you heard that right. Banks were lending enormous sums of money to people with no documented ability to ever repay it, all because they could immediately sell that loan to somebody else. It was a complete and total abandonment of common sense.
The long-term view here is just jaw-dropping. For an entire century, from the 1890s all the way to the 1990s, real home prices in the U.S. were incredibly stable. They pretty much just went up with inflation. Then, in the early 2000s, pumped full of all that easy money, they suddenly doubled in just a few years. The result was a collapse that wiped out trillions in household wealth and pushed the entire global financial system right to the edge of the cliff. So that brings us to our most recent era of speculation, which really shows how technology has changed the game yet again. Social media platforms like Reddit and Twitter now basically act as super efficient amplifiers for that positive feedback loop we talked about, cranking the entire bubble cycle up to warp speed. The whole GameStop saga is the perfect example. I mean, here you have a struggling video game store whose stock went from about $17 to almost $400 and then back down below 40, all within a couple of weeks. This had nothing to do with business fundamentals. It was driven by an online army of traders on forums like Wall Street Pets, all hyped up by a David versus Goliath story against hedge funds and the now famous mantra, YOLO, you only live once. And then, of course, there's crypto. To get a handle on the Bitcoin phenomenon, we have to ask a really simple economic question. Is it actually money? Well, money needs to do three things. It has to be a medium of exchange. And okay, you can buy some stuff with Bitcoin, check. But it also has to be a stable unit of account and a reliable store of value. And here's the massive problem. When an asset can lose 20% of its value overnight, it is a terrible yardstick for pricing things, and it is a terrifyingly unreliable way to store your savings. You know, it reminds me of this classic old story of the sardine trader. A new guy buys a huge shipment of canned sardines for a high price. One day, he decides to open a can for lunch and realizes the fish inside are disgusting, totally ranted. He goes and confronts the guy who sold them to him, and the seller just replies, "You fool, those aren't eating sardines. Those are trading sardines." For a lot of people, assets like Bitcoin became exactly that, objects of pure speculation completely disconnected from any real-world use or value. So, after walking through these three enormous bubbles, we get to the most important question of all. What is the real lesson here? And why does it seem that with every new technology, with every new generation, we just keep falling into the same old trap? You know, it's a totally fair question to ask. After seeing the absurdity of the dot-com bubble, the delusion of the housing crash, and the sheer mania of meme stocks, it's really easy to just conclude that the whole idea of a rational, efficient market is a complete fantasy. I mean, how can a market that behaves like this be considered efficient at all? But here's the counterpoint, and it comes from the father of value investing himself, Benjamin Graham. He said that in the short run, the market is a voting machine. It's a popularity contest driven by emotion and hype and fear. But in the long run, it's a weighing machine. Eventually, gravity reasserts itself. The hype always fades, and prices eventually correct to reflect the true underlying value of an asset. The madness is always temporary, but the reckoning, that's inevitable. And so we end right back where we started. The lesson of history is crystal clear. There will always be another bubble. The technology will be new, the story will sound different, but the human psychology of greed and fear, that's a constant. The next mania might already be starting to inflate right now. The only real question is, now that you've seen the pattern, will you be able to keep your head when everyone around you starts to lose theirs?
Okay, just imagine for a second. A trader, their hand on a mouse, about to move $1 billion with just one click. What is going on in their head at that exact moment? Are they looking at a chart, trying to read the future like some kind of fortune teller? Or are they buried in a spreadsheet, trying to calculate the very soul of a company? That single decision, buy or sell, it's the biggest question on Wall Street. And you know what? It literally splits the entire industry right down the middle.
And we're not just talking about some small-time trades here. When you add up all the stocks, the futures, the options, the swaps, we are talking about trillions of dollars changing hands every single day. With that kind of money flying around, you can't just go with your gut. You need a system, right? A philosophy. The big problem is, the two main systems are basically at war with each other. And that really is the million-dollar, or I guess trillion-dollar question. It's the puzzle that has launched countless strategies, some of them brilliant, some of them, well, let's just say they're a little out there. Today, we're going to break down the two big, often clashing schools of thought that really drive Wall Street. So here's the plan. We'll kick things off by looking at these two warring philosophies. Then, we'll dive into the world of the chartist and their crystal ball. After that, we'll check out the fundamentalists' formula for finding value. Then, and this is important, we'll see why both of these methods can fail spectacularly. And we'll wrap it all up with a practical way to bring the two together.
All right, let's get into it. The whole debate really comes down to one core disagreement about what the stock market even is. Is it some kind of logical machine that you can solve with a calculator, or is it more of a psychological battlefield driven by the emotions of the crowd?
And this slide really lays it all out. On the left, you've got technical analysis, which is all about psychology. It runs on something called the castle in the air theory. The idea is that a stock is only worth whatever the next person is willing to pay for it. So your job isn't to find its true value, it's to guess what the crowd is going to do next.
Then on the other side, you have fundamental analysis, which is all logic. It's about finding a firm foundation, a real intrinsic value based on cold, hard facts about the company, no matter what the market mood is.
So let's meet our first contender, the chartist. These are the technicians, the people who believe the market is 90% psychology and maybe, just maybe, 10% logic. For them, the game isn't about crunching numbers. It's about trying to read the collective mind of the market.
So how do they do it? Well, it's all in the charts. The first big idea of technical analysis is that everything you could possibly want to know, news, earnings, you name it, is already baked into the stock's price history. The second idea is that prices move in trends. A stock that's going up tends to keep going up. So for a chartist, the chart itself is the only tool they'll ever need.
And this quote, wow, it just perfectly captures that mindset. A true chartist could not care less what a company actually does. They don't read the news. In fact, the legendary technician John Maggi famously boarded up the windows of his office so he wouldn't be influenced by whether it was sunny or rainy outside. The chart was his entire universe.
So let's try to see the market through a chartist's eyes. They'll spot a stock that's in an uptrend, and they'll immediately start connecting the dots, literally. They'll draw a line across the highs, another one across the lows, and boom, you've got a channel. In their world, as long as the stock keeps bouncing between those two lines, the herd is still running in the right direction.
But then, things start to change. The momentum stalls out. The stock hits a ceiling, what they call a resistance level, and it gets knocked back down. That's your left shoulder. It tries to rally again, pushing even higher, but it fails. That's the head. Then there's one last weaker attempt to go up, but the energy's just gone. It falls back again, forming the right shoulder. You see it? The pattern is taking shape.
And there it is, the classic and very bearish head and shoulders formation. The picture is now complete. The chartist waits for that one final confirmation, and when the price finally breaks below the neckline, that support level connecting the lows, the signal is absolutely unmistakable: sell. The market's mind supposedly has just been read.
Okay, now let's do a complete 180 and jump into a totally different worldview. For the fundamentalist, all that chart stuff we just talked about is just noise. They believe the market is 90% logical. They are not trying to guess what the crowd is up to. They are financial detectives on the hunt for a company's true underlying worth. So the fundamentalist's job is basically to be a prophet, but, without any divine help. They dig through everything: income statements, balance sheets, industry trends, the quality of the management team. Their entire goal is to estimate all the future earnings and dividends a company will ever produce, and then figure out what that whole stream of future cash is worth today. That final number, that is the firm foundation of value. Now, to really get inside a fundamentalist's head, you have to appreciate the most powerful force in their universe: compound growth. We've all heard the story about Manhattan Island being sold for just $24. It sounds like the worst deal in history, right? Well, what if that $24 had been invested at 6% interest? Thanks to the magic of compounding, it would be worth over $100 billion today. That's enough to buy back a pretty good chunk of modern Manhattan. Albert Einstein called compound interest the greatest mathematical discovery of all time, and it is the engine that drives every single one of a fundamentalist's calculations. So how do they actually come up with a value? Well, they focus on 4 key levers. First, growth. How fast are earnings going to grow? Faster is better. Second, the dividend payout. How much cash does the company actually give back to its shareholders? More is better. Third, risk. How sure are we about those future earnings? Less risk is always better. And finally, number 4, interest rates. What could I earn in a super safe government bond instead? The higher those rates go, the less attractive a stock becomes. They plug all these assumptions into their models, and out pops a single number, the firm foundation of value.
Okay, so we've got 2 very different, very plausible systems for making decisions. The chartist has their patterns, the fundamentalist has their formulas. But if these systems really work so well, then why isn't every single analyst on Wall Street a billionaire? This is where both theories start to fall apart. Turns out, both the crystal ball and the calculator have some pretty serious flaws. For the chartists, that crystal ball can shatter into a million pieces. Because they wait for a trend to be clear, they're almost always late to the party. They end up buying after the big move up and selling after the big move down. And worse, the charts can flat out lie. If everyone sees the same sell signal, they all rush for the exit at once, and it just becomes a self-fulfilling prophecy. And sometimes the market sets a bear trap,
a fake-out sell signal right before the stock absolutely skyrockets, leaving the chartist behind in the dust. And you know what? The fundamentalist calculator isn't any safer. Its biggest flaw is that it pretends to predict the future, which is, of course, impossible. Your entire firm foundation can completely crumble based on just one assumption. If you change your growth estimate from 10% to just 9%, your so-called can't-miss stock can suddenly look like something you should sell immediately. And the most frustrating thing of all, even if you're 100% right about the value, the market can just ignore you for years.
So where does all this leave us? Should we just give up? Not at all. Maybe the smartest approach isn't to pick a team, but to build a hybrid strategy, one that combines the artist's intuition with the detective's logic.
And this strategy really comes down to 3 simple rules. Rule number 1, start like a fundamentalist. Find companies that you truly believe will have strong, above-average growth for at least 5 years. Rule number 2, and this one is so important, never overpay. A great tool for this is the PEG ratio. It's super simple. It just compares a stock's PE multiple to its growth rate. A ratio around 1 means the price is probably fair for the growth you're getting. And finally, rule number 3, think like a chartist. Look for companies that have a great story, something that can really capture the public's imagination and help build that castle in the air.
And this right here, this is the holy grail of the hybrid strategy. It's what they call the double bonus. Here's how it works. First, as the company's earnings grow, the stock price should naturally go up with it. That's your first win. But then, as the rest of the market starts to notice this success, people get more excited. They become willing to pay a higher price for every dollar of earnings the company makes. That's the PE multiple expanding, and that's your second win. You get paid twice for making one good decision.
In the end, it all comes back to that one essential question. Do you see the market as a logical machine, a puzzle that can be solved if you just have the right formula? Or is it a deeply human drama, driven by fear and greed and hope, a story that you can try to understand but never, ever perfectly predict? The real answer, I think, has to be somewhere in the middle.
All right, let's talk about something that is just so incredibly tempting for any investor: the world of technical analysis. You know, this idea that stock charts aren't just a record of the past, but that they're actually treasure maps, maps that hold the secrets to the market's very next move. It's a world full of its own lingo, really bold predictions, and this dream that you can get rich just by reading the squiggles on a screen. But you have to ask, does it actually work? Well, that's exactly what we're going to get into today. This quote from Gilbert and Sullivan, man, it just hits the nail on the head for what we're talking about. We're going to peel back the curtain a little bit and ask a tough question. Are the patterns that technicians see in the market real, predictive signals, or are they just skim milk pretending to be cream?
I bet you've heard some of these phrases before, right? Don't fight the tape, hold the winners. These are the classic mantras of technical analysts, or chartists, as they're often called. Their core belief is that everything you could possibly need to know, investor psychology, economic news, company profits, it's all already reflected or baked in to the stock's price history on the chart. And the promise? Oh, the promise is powerful. Use their tools, and you can get in on the ground floor of the next Amazon or Google. And that leads to a really simple but kind of devastating question that gets right to the heart of this. If these chart-reading methods are so good at making money, why isn't every single technical analyst sipping cocktails on their own private island? This is the big puzzle we need to explore. You know, the author of our source material shares this really funny observation about this whole paradox. When you ask a technician who isn't rich why their system didn't work out, the answer is almost always something like this. They don't blame the charts. No. They blame themselves. I lost my nerve. I didn't trust the signal. It's a perfect defense, really, because it means the system is never wrong. And that keeps the whole myth alive. So here's our game plan for today. First, we're going to talk about why the charts are so alluring in the first place. Then, we'll run a really fascinating experiment that might just change how you see things. After that, we'll put some of the most popular theories to the test against cold, hard research. We'll look at the psychology of why our brains see patterns that aren't there. And finally, we'll boil it all down to a simple, practical takeaway for you. Okay, first things first. Let's just admit it. The idea of predicting the market is incredibly appealing. I mean, who wouldn't want a system that tells you exactly when to buy and exactly when to sell? It gives you this feeling of control in an environment, the stock market, that often feels completely out of our control. It's a really powerful psychological pull. And now for a little experiment that I think gets right to the core of this whole debate. We're going to ask a really simple question.
Can a process that is 100% random, something as simple as flipping a coin, create a chart that looks for all the world like a real stock chart? Let's find out.
So, the fundamental belief behind chart analysis is sometimes called the wallpaper principle. Think about it like this. If you're looking at a wall with patterned wallpaper and part of it is covered by a big mirror, you can pretty confidently guess what the pattern looks like behind the mirror, right? Chartists apply that exact same logic to stocks. They believe the patterns from the past will reliably repeat themselves in the future. So here's how our experiment is going to work. It's dead simple. We're going to invent a stock and say it starts at $50. Then, for every day of trading, we just flip a regular, fair coin. If it's heads, the stock goes up by $0.50. If it's tails, it goes down by $0.50. That's it. Every single day's outcome is a pure 50-50 shot, and it has absolutely nothing to do with the day before. We'll do that a bunch of times and plot the results. So what do we get? This. This is what we get. Now, I want you to just look at that chart for a second. Forget everything I just told you about the coin flips. If you saw this chart on its own, what would you think? I mean, you can clearly see an early run-up, then a pretty nasty downtrend, followed by a strong recovery. It even looks like it's forming a head and shoulders bottom and breaking out. So based only on what you see here, would you buy this stock? And here it is, the big reveal. This chart, with its convincing trends, its support and resistance levels, its beautiful breakout pattern, was generated by a simple, random 50-50 coin toss. Every single up and down movement was pure chance. Those trends you see, they're just statistical illusions. They're the kind of lucky streaks you would fully expect to see in any long series of random events. And that little experiment is a perfect illustration of what's known as the random walk theory. At its core, it's pretty simple. It says that past price movements of a stock cannot be used to predict its future movements. The path a stock price follows is a random walk, just like our coin toss chart. According to this theory, the market, well, it has a very, very short memory, if any at all. Okay, so if a completely random process can fake a stock chart so convincingly, what happens when we put these technical trading strategies under a scientific microscope? Well, academics approach this a lot like a clinical drug trial. The technical strategy is the new, fancy drug, and the placebo, that's just a simple buy and hold strategy. The question is, does the fancy drug actually work any better than the sugar pill? This quote from economist Richard Quant, well, it pretty much sums up how the academic world feels about this. They don't pull any punches. After decades of rigorous testing, researchers have found almost no credible evidence to back up the claims made by chartists. The big takeaway is that while these ideas are wildly popular, they just don't seem to survive when you actually put them to the test. All right, let's look at a few specific strategies. First up is the filter system. The logic seems reasonable, right? You buy a stock only after it's proven it's going up by, say, 5%, and you sell it after it falls by 5%. The idea is to ride the trends. But here's the problem. These systems make you trade a lot, and by the time you get the buy signal, you've often missed the best part of the move. When researchers tested this exhaustively, they found that once you subtract all the commissions and taxes from that frantic trading, you end up doing worse than the person who just bought the stock and went on vacation. Okay, how about the granddaddy of them all, the Dow theory? This is all about those support and resistance levels. You know, those imaginary price ceilings and floors. The strategy is to buy when a stock smashes through a previous high point and sell when it crashes below a previous low. It sounds smart, like you're waiting for a really strong signal, but again, when you run the numbers, those so-called breakouts don't mean anything. The stock is just as likely to turn around as it is to keep going. And all that extra trading just eats into your returns, leaving you slightly behind buy and hold. Now, what about momentum? This is the idea of simply buying what's hot and selling what's not. It's called a relative strength system. And to be fair, of all the technical theories, this is the one that has a tiny bit of academic backing. There's some evidence that trends can sometimes persist for a short while. But, and this is a big but, trying to actually make money off this is incredibly hard. And again, once the computers factor in all the trading costs and taxes, any small edge just disappears. You're often left chasing performance and trailing a simple index fund. And then you get into some of the more, let's say, creative theories out there.
You've got the hemline indicator, which seriously suggested that rising skirt lengths meant a rising market. You've got the Super Bowl indicator, which predicts the market's entire year based on which football conference wins. And look, while you might find some weird correlations in past data, the verdict is in. These are fun little curiosities, not serious ways to invest your money. So this begs a huge question. If all the evidence is stacked so high against these theories, why are they still so incredibly popular? Why do we stare at that random coin toss chart and see undeniable, predictable patterns? Well, the answer isn't in the stock market. It's in our own heads. The reason is actually pretty simple. Our brains are hardwired to be pattern-seeking machines. We evolved to find order and make sense of the world, even when we're just looking at total randomness. We are deeply, deeply uncomfortable with the idea of pure chaos. So, when we look at a stock chart, our brain automatically starts searching for a story, for a cause and effect, for a pattern, even if there isn't one there. This is perfectly captured by something called the hot hand fallacy in basketball. I mean, everybody believes in it. Fans, players, coaches. If a player makes a few shots in a row, everyone thinks they're hot and are more likely to make the next one. But when statisticians actually analyzed thousands of shots in the NBA, they found zero evidence for it. A player's chance of making their next shot has nothing to do with whether they made their last one. It's just a random streak that our pattern-seeking brains mistake for a real phenomenon. The same thing happens with stocks. Okay, so we've covered a lot of ground. We've looked at the theory, we've run the experiment, we've dived into the psychology. Let's bring it all home. What does all of this actually mean for you as an individual trying to grow your money for the long haul? If you need just one number to convince you that trying to time the market is a dangerous game, let it be this one. One study looked at 30 years of stock market returns and found that a jaw-dropping 95% of the total gains happened on just 90 specific trading days. 90 days out of more than 7,000. If your charting system had you on the sidelines, in cash, on just those few critical days, you would have missed almost all of the market's long-term growth. The biggest risk isn't being wrong, it's being out of the market. And that leads us to a final thought, a final question that kind of wraps this all up. Just imagine for a second that a simple technical rule actually worked. Let's say everybody knew for a fact that stocks always go up on Fridays. What would happen? Well, smart people would start buying on Thursday to get ahead of the move, but that would just make prices go up on Thursday. Then people would start buying on Wednesday. Pretty soon, the pattern would be completely traded away until it vanished. Any simple, profitable pattern is, by its very nature, self-destructing. And that, right there, is probably the best argument for why the random walk continues and why the charts may hold a lot of history, but probably not the secrets to your future wealth.
You turn on the TV and you see these incredibly confident, highly paid stock-picking experts. And you have to wonder, do these guys have some kind of crystal ball? Well, today, we're putting that whole idea to the test. We're going to ask a really simple but really important question. How good is fundamental analysis, really? Are these masters of the universe actually masters, or are they just lucky?
These were the words of John F. Kennedy after a pretty disastrous military operation. But that feeling, man, it's something countless investors know all too well. You follow the expert advice and you get burned. This quote right here, this is our starting point. It's a powerful reminder to always question authority, especially when it's your own money on the line.
All right, so here's our game plan. First up, we're going to meet the quintessential Wall Street star. Then we'll pit them against a very unlikely challenger. After that, we'll figure out why their crystal balls seem so foggy and check out the scoreboard, because the numbers don't lie. And finally, we'll dive into a powerful theory that ties it all together and get the final, surprising verdict from the legends themselves.
So let's kick things off with the main character in this whole drama, the Wall Street analyst. You know them. They're the gatekeepers, the big shots, the celebrities of the stock market. But it wasn't always like this. Their journey is really one from quiet statistician to full-blown media superstar.
I mean, think about it. The image has totally changed. It's gone from a backroom number cruncher with one of those old green eye shades to a front-page personality in a sharp suit. These are the equity research stars you see on financial news, right? Their buy or sell call can literally move markets, sending billions of dollars flying around. Their firms love to parade them around to win huge deals. They just ooze this aura of genius. But here's the real question. Is that confidence actually earned?
And that question, well, that leads us right to the heart of the debate. This is the main event. It's a total clash of worldviews. Wall Street's absolute belief in its own genius versus a
Let's just say a devastatingly simple critique from the world of academia.
Okay, so in one corner, you've got Wall Street. Their argument is pretty straightforward. We're the professionals. We have the fancy models, the teams of analysts, the connections. We have a huge edge. But in the other corner, you have academia. And they're making a claim that is just wild. They're saying that a blindfolded monkey throwing darts at a stock page could pick a portfolio that does just as well as the pros. It sounds completely absurd, right? But is it? Let's see who really wins this thing, the master or the monkey.
So to really get to the bottom of this, we have to understand why predicting the future is just so ridiculously hard. I mean, even for the people getting paid millions to do it. Let's peel back the curtain and look at the real reasons their crystal balls are always so clouded.
So it turns out there are about 5 massive flaws just baked right into the system. First, just pure dumb luck. Random events, a natural disaster, a surprise invention, they can blow up any forecast. Second, creative accounting, which lets companies legally hide what's really going on. Third, just plain old human error. Analysts make mistakes, they get lazy, they're just wrong. Fourth, the best analysts, well, they often get promoted out of analysis and into management or sales. And finally, the really big one, massive, unavoidable conflicts of interest.
This quote just nails the whole creative accounting problem, doesn't it? A company can follow all the rules, dot every I, and still hide the most vital information about its financial health. They use all these little tricks to pull revenue out of thin air or show you what they call pro forma earnings, which one critic perfectly called earnings before all the bad stuff. It just turns an analyst's search for truth into a trip through a hall of mirrors.
And the real-world blunders are they're jaw-dropping. We are talking about analysts literally misplacing a decimal point, making a stock look 10 times cheaper than it really was. You have analysts who fundamentally do not understand the industries they're supposed to be experts in. Back in the dot-com bubble, the ratio of buy-to-sell recommendations was 100 to 1. And get this, right after the BP oil spill, the biggest environmental disaster of its kind, with the stock in freefall, 27 out of 34 analysts were still calling it a buy. Not a single one said sell. The stock then proceeded to lose another half of its value. It's just staggering.
Okay, so we've seen all the reasons why analysts might fail, but what about the cold hard numbers? The proof is in the performance, right? So let's pull up the official scorecard for the pros who manage billions of dollars in mutual funds.
Just look at this number for a second. 94.1%. That is the percentage of U.S. large company mutual funds that failed to beat a simple, plain vanilla market index, the S&P 500, over 20 years. Let that sink in for a minute. More than 9 out of 10 professionals, the supposed best and brightest in the world, could not do better than a basic, unmanaged basket of stocks.
And look, this isn't some weird fluke. It's not a one-off. Just look at the data across the board. Small company funds, over 93% fail to beat their benchmark. Global funds, over 85% fail. Even in so-called emerging markets, where you'd think the pros would have an edge, over 93% fail. The conclusion here is just impossible to avoid. Professional underperformance isn't the exception. It is the overwhelming, crushing rule. As a group, they are consistently losing to the market.
So what about that small handful that does beat the market in a given year? What about those superstar managers you hear about? If it isn't skill, then what is it? Well, all the evidence points to one thing: luck. Plain and simple. There's a reason every single investment prospectus has that famous warning, right? Past performance is no guarantee of future results, because today's genius is, all too often, tomorrow's cautionary tale. Let me paint you a picture. Imagine we get 1,000 people together for a giant coin flipping contest. After the first flip, about 500 of them will have guessed right. They move on. After the second flip, 250 are left. You keep going, and by the 7th round, you're going to have about 8 people who have been right 7 times in a row. Now, are they coin-flipping geniuses? Do they have a special skill? Of course not. They just got lucky. Now imagine that with thousands and thousands of fund managers. The laws of probability absolutely guarantee that a few of them will look like incredible geniuses for a while, purely by random chance.
Okay, so if it's not skill and even the smartest people in the room are failing, what on earth is going on? Well, that brings us to this powerful, really elegant academic theory that explains pretty much everything we've just seen. It's called the efficient market hypothesis.
So the core idea here is actually pretty simple, but it's incredibly powerful. The theory says that in a market with millions of smart, motivated people all trying to get an edge, any new piece of public information, an earnings report, a news story, whatever, gets absorbed and baked into a stock's price almost instantly. And what that means is, by the time you hear the news and try to act on it, the opportunity is already gone. The party's over.
Now, this theory comes in a few different flavors. The weak form basically says you can't beat the market just by looking at old price charts. So, sorry technical analysts. Then there's the semi-strong form, which is the one most people believe. It says you can't win using any publicly available information, which, if true, makes fundamental analysis pretty much useless. And finally, the strong form says even illegal insider information won't help, though that one's a bit more theoretical.
Now, this is a really, really important point to understand. This theory does not say that stock prices are always correct. In fact, they're almost certainly wrong in some cosmic sense. What it says is that nobody can know for sure how they're wrong, whether a stock is too high or too low. The market is efficient not because it's perfect, but because it's an unbelievably fast information processing machine. It digests new, unpredictable information so quickly that no single person can consistently outsmart the entire crowd.
So after all of this, where does that leave us? I mean, if the pros, with all their resources, can't reliably beat the market, what chance does a regular investor really have? Well, for the answer to that, let's turn to the final verdict from some of the absolute legends of investing. And what they have to say, well, it might just shock you.
This is just a bombshell. This quote is from Benjamin Graham. This is the man who literally wrote the book on security analysis. He's the father of value investing. He was Warren Buffett's mentor. And here he is, at the end of his amazing career, basically admitting that the game had changed. He conceded that the very techniques he invented just didn't work well enough anymore. Even the founding father of it all eventually came over to the efficient market camp.
And hey, if you're not convinced by the teacher, just listen to his greatest student. This is Warren Buffett, arguably the greatest active investor of all time. And what's his advice for most people? Don't try to do what he does. He says the best thing for most of us is to just buy a broad market index fund. And he's not just talking, he's putting his money where his mouth is. His own will states that 90% of the money left to his wife is to be put into a simple, low-cost S&P 500 index fund.
And that brings us to our final big thought. The evidence is just overwhelming. Trying to find that one magic stock, that needle in the haystack, is a losing game for almost everyone. So the question you've got to ask yourself is this: if finding the needle is next to impossible, why not just take the simpler, smarter path and just buy the whole haystack?
So what if I told you there's a way to actually tame investment risk? I mean, an idea so powerful, it won a Nobel Prize and pretty much rewrote the entire rule book for finance. Well, today, that's what we're going to do. We're going to break down the brilliant idea of modern portfolio theory. I absolutely love this quote from John Maynard Keynes. It just nails a huge truth. A lot of our gut feelings about money, about investing, they didn't just pop out of nowhere. They actually trace back to some big academic theory from way back when. And the theory we're digging into today, it's one of the biggest of them all. All right, so let's just start with the question every single investor dreams about. It's the Holy Grail, right? Because it seems impossible. For centuries, the wisdom was simple. You want more reward, you got to take more risk. End of story. But then an idea came along that changed everything. So here's our game plan for today. First, we're going to look at that classic investor's dilemma. Then, we'll nail down what risk actually means when we're talking about money. After that, we'll get to the fun part, the one free lunch in investing. We'll see how it plays out in the real world, and then we'll ask the big question, does it still hold up today? Okay, first things first. We have to really understand the problem that this whole theory was designed to solve. It's that fundamental trade-off that has been the reality for investors forever. That simple, and let's be honest, often painful rule that you just can't get something for nothing. Just look at this chart. It lays out almost 100 years of data, and the story it tells is crystal clear. See that column on the right, standard deviation? That's just a fancy finance term for how bumpy the ride is. The bigger the number, the crazier the swings. And the pattern is impossible to miss, right? Super safe treasury bills give you a calm, steady return. But to get that awesome 12.1% average from small company stocks, you had to buckle up and endure some absolutely massive volatility. So the bottom line is this. For a very, very long time, this was basically the iron law of finance. The only road to higher returns was paved with more risk. It was a one-way street. You had to pick your poison, the slow and steady path of safety or the wild, unpredictable path of high potential.
So if our goal is to try and reduce risk, we first have to get on the same page about what it even is. I mean, we all throw that word around, but in the world of finance, it's not just a feeling. It has a very specific meaning, and it's something we can actually measure. And here's the mental shift you have to make. For academics, risk isn't just the chance you'll lose money. It's the uncertainty of the whole thing. It's how much your actual results are likely to jump around from what you expect, whether that's up or down. A really wide range of possible outcomes, even a bunch of really good ones, means higher risk simply because it's less predictable. Let's make this a little more concrete. Just imagine a stock where there are 3 possible things that can happen, and each one is equally likely. A third of the time, the economy booms, and you make 30%. A third of the time, things are normal, you make 10%. And a third of the time, things are bad, and you lose 10%. Well, you average those 3 outcomes, and your expected return over the long haul is 10%. That's the center point that we measure all the volatility against. Now, don't worry, you do not need to be a math whiz to get the idea here. All we're really doing to calculate that risk number is measuring how far away each of those possible outcomes is from our 10% average. The bigger those jumps are, the bigger the final risk number is going to be. Simple as that. And here's what all that theory looks like in the real world. This is the S&P 500. You can see that most of the months are clustered right there around the middle, with a small positive return. But look at the edges. See those tails? You've got some months with incredible gains, but you've also got months with absolutely terrifying losses. That huge spread, that is risk, made visual. Okay, now we get to the breakthrough. Back in the 1950s, this brilliant young economist, Harry Markowitz, comes along and he asks a question that would change everything. He said, what happens if we stop looking at assets one by one and instead we look at how they act together as a team in a portfolio? So, to really get his idea, let's use a super simple story. Imagine an island with only 2 businesses. You've got the sunny day resort, which makes a killing when the weather's beautiful, and you've got rainy day umbrellas, which, you guessed it, does great when it pours. Their success is perfectly opposite. Now look at the numbers. If you put all your money in the resort, it's a total roller coaster. You're either up 50% or down 25%. Same thing if you only own the umbrella company. By themselves, each one is an incredibly risky bet. But, and this is the magic trick, if you put half of your money in each company, look what happens. When it's sunny, the resort's huge gain more than covers the umbrella company's loss. When it's rainy, the umbrella company's big win covers the resort's loss. You end up with the exact same predictable 12.5% return no matter what the weather does. It's amazing. You've combined 2 super risky things to create one perfectly safe, predictable investment. So, what's the secret ingredient here? It's a concept from statistics called correlation. It's just a number between -1 and +1 that tells you how 2 things move together. Our island businesses had a perfect negative correlation. But here's the truly brilliant part of Markowitz's idea. You don't need that perfect opposite relationship. As long as 2 investments don't move in perfect lockstep, as long as their correlation is anything less than a perfect positive one, then combining them will reduce your overall portfolio risk. Okay, that island story is a nice, neat little example. But how does this elegant theory actually apply to the messy, complicated, real world of global stock markets? And this is where things get really fascinating, and honestly, a little counterintuitive. If you look at the historical data, you'll see that, as a group, foreign stocks were more volatile than U.S. stocks. So common sense would tell you, hey, if I add a riskier ingredient to my portfolio, the whole thing should get riskier, right? Well, not exactly. The data here is pretty mind-blowing. That bar on the left, that's the risk of a portfolio with only U.S. stocks. The bar on the far right, that's the higher risk of a portfolio with only foreign stocks. But look at the one in the middle, a mix of the 2. It actually had the lowest overall risk. Think about that. By adding the quote-unquote riskier ingredient, the entire portfolio actually became safer. And that is exactly why people call diversification the only free lunch in finance. It worked because the U.S. economy and foreign economies weren't perfectly in sync. They didn't always have a good year at the same time or a bad year at the same time. Their ups and downs tended to cancel each other out, smoothing out the ride for the entire portfolio. Now, this all sounds fantastic, and it clearly worked wonders in the past. But let's be real, it's a fair question to ask.
In our crazy, hyper-connected, globalized world today, does this free lunch still exist? And this is, without a doubt, the biggest challenge to the theory today. As all of our economies have gotten more and more tangled up, markets around the world tend to move together more than they used to, and you especially see this during a crisis. Think about 2008 or the COVID crash in 2020. It felt like there was just nowhere to hide, didn't it? Everything went down at the same time. And that rising correlation, it definitely weakens the diversification effect. But, and this is a big but, the principle isn't broken. It just means we have to be a little smarter about it. The solution is to diversify even more broadly. For instance, think back to the 2000s. It was a lost decade for US stocks. They basically went nowhere. But emerging markets, they were soaring. And even more important, you have to diversify across different types of assets. In 2008, when stocks were in a free fall, high-quality government bonds actually went up, acting as the perfect ballast for a portfolio. So what's the one big idea you should walk away with? We started with that old iron law: higher return demands higher risk. But the absolute genius of modern portfolio theory was showing us a way to bend that rule. And the key isn't about being a genius stock picker, it's about being a smart team builder. The lesson is timeless. Stop obsessing over how any single investment is doing. Instead, ask a much more powerful question. How does this investment fit in with everything else I own? Because at the end of the day, taming risk isn't about finding the perfect asset. It's about building the perfect combination.
You know, for every single one of us who invests, there's this one fundamental challenge, right? It's the constant dance between risk and reward. We all kind of instinctively know that to get a higher return, you usually have to take on more risk. But what is risk, really? For decades, the big scramble has been to find a truly scientific way to measure it, to control it, and hopefully to use it to our advantage. And that's the incredible story we're going to dive into today.
And you know this quote from the economist George Stigler? It just hits the nail on the head. When we're talking about your money, having a flawed idea about risk isn't just a little unhelpful. It's actually worse than just flipping a coin. It's like they say a bad map is way more dangerous than no map at all. So that's the big question, right? The multi-million-dollar question we're going to unpack. How did some of the smartest minds on Wall Street and in academia try to finally get a handle on all the uncertainty in the market? And how did they try to boil down something as wild and complex as risk into a single, clean number that you or I could actually use? All right, so let's get into it. Our story kicks off with a major breakthrough in what's known as modern portfolio theory. It was an idea that really promised to finally solve this whole risk-reward puzzle once and for all. Okay, so the first big aha moment was this. The total risk of any given stock isn't just one big messy thing. It can actually be split into two totally different categories. And trust me, understanding the difference between these two is the key to everything that comes next. So first up, you've got what's called unsystematic risk. The easiest way to think about this is it's company-specific drama. You know, a star CEO suddenly resigns, a blockbuster new drug fails its final trial, a key factory has a fire. These are things that are totally unique to one company's story. And then, on the other side, you have systematic risk. Now, this is the big stuff. This is the tide that lifts or sinks all the boats in the harbor. We're talking about a global recession, a sudden spike in interest rates, a major geopolitical crisis, things that hit pretty much every company out there, no matter how well they're managed. This is what we call market risk. Now, this is where it gets really, really important. Here's the critical difference. That company-specific stuff, the unsystematic risk, you can actually make it disappear just by diversifying, by owning a whole bunch of different stocks. The bad news from one company just gets canceled out by the good news from another. But you absolutely cannot diversify away systematic risk. No matter how many different stocks you own, you just can't hide from a market-wide crash. So this amazing insight became the foundation for the Nobel Prize-winning capital asset pricing model, or CAP for short. And the logic is actually beautiful. It goes like this. Why would the market reward you for taking on a risk, that unsystematic, company-specific risk, that you could have gotten rid of for free just by buying a few more stocks? Well, a rational market wouldn't. So the theory says the only risk you actually get paid to take is the one you can't escape, systematic risk. This theory was absolutely revolutionary, but it created a brand new problem. If systematic risk is the only thing that matters for your returns,
how in the world do you measure it? Well, the answer came in the form of a single, humble Greek letter.
Meet beta. Beta was designed to be the ultimate, definitive number for systematic risk. At its core, it's just a comparison. It measures how much a single stock tends to zig or zag when the overall market zigs or zags. It's basically a measure of a stock's sensitivity to the market's mood swings.
And here's how you read it. It's super simple. The market as a whole, let's say the S&P 500, is just defined as having a beta of 1.0. Now, if your stock has a beta higher than 1, maybe 1.5, it's considered aggressive. It tends to move 50% more than the market, both on the way up and on the way down. If its beta is less than 1, say 0.7, it's called a defensive stock. It's just less jumpy than the rest of the market.
And just like that, with this one elegant number, the puzzle seems solved. Want higher returns? Simple. Build a portfolio with a high beta. Want to play it safe? Go for low beta stocks. This idea didn't just stay in academia. It stormed Wall Street in the 70s. I mean, there was literally a beta cult. Money managers who could barely do long division were suddenly throwing around the word beta like they were statistics professors.
It was a beautiful theory. Elegant, simple, almost too perfect. Because when this pristine academic model finally collided with the messy, chaotic reality of the stock market, well, let's just say some serious cracks started to appear.
You know, Shakespeare just nailed it here. It's one thing to come up with a theory. Anybody can call spirits from the vasty deep. But the real question is, does it actually work in the real world? Will those higher returns actually show up when you call for them by buying those high beta stocks?
So in 1992, a couple of researchers, Eugene Fama and Kenneth French, decided it was time to stop theorizing and just look at the data. They took this massive data set, almost 3 decades of actual stock returns, from 1963 to 1990, and they asked one simple question. Did portfolios of high beta stocks really deliver higher returns than portfolios of low beta stocks, like the theory said they should? And what they found, well, it was a bombshell that rocked the entire financial world. The relationship between beta and your returns wasn't a nice, clean, upward-sloping line. As you can see, it was basically flat. Over nearly 30 years, the stocks with the highest risk, the highest beta, earned almost the exact same average return as the stocks with the lowest beta. The reward for taking on all that extra market risk, it just wasn't there.
You can just imagine the chaos, right? The fallout was immediate. The same financial magazines that had been singing the praises of the beta cult were now writing its obituary. We saw headlines like, "The Death of Beta." One quantitative analyst, a quant, famously wrote in a public letter, "The capital asset pricing model is dead." It looked like this beautiful, elegant theory had been murdered by a gang of ugly facts.
But hold on, was the story really that simple? Was beta really dead and buried? Not so fast. A defense was about to be mounted, and it was a pretty smart one. And it all boiled down to this one critical question. Was the core idea of the model, the part that says you're only rewarded for taking systematic risk, was that fundamentally wrong? Or was beta just a really flawed way of measuring that risk? So the defenders of the theory came back with 3 really powerful arguments. First, they said, hey, maybe we're just measuring beta against the wrong market. The S&P 500 isn't everything. The true market includes bonds, real estate, even your own future earning potential. Second, a stock's beta isn't some fixed number carved in stone. It changes over time. And third, and this is my favorite part, maybe the Fama-French study doesn't prove beta is useless at all. Maybe it proves it's more valuable than ever. I mean, think about it. If you can get the same return from a low beta stock as a high beta one, you're getting a much better deal for the risk you're taking. That's a huge win.
What's so fascinating is that this whole debate didn't kill quantitative investing, just the opposite. It kicked it into hyperdrive. And that brings us to our final chapter, the quest for factors. The failure of a single factor model, just using beta, led directly to the creation of much smarter, multi-factor models to explain how the market really works. And guess who led this next wave? The very same guys who supposedly killed beta in the first place, Fama and French. They came back and proposed a 3-factor model. They said, look, to really understand a stock's return, beta still matters, but it's not the whole story. You also have to look at its size, because smaller companies tend to be riskier and offer higher returns, and its value, meaning stocks that are cheap compared to their assets, also tend to behave in a unique way.
And that just completely changed the game. The search for one single magic number for risk was over. It was replaced by a hunt for multiple factors. Today, the most sophisticated investors look at a whole universe of things, way beyond beta, size, and value. They're looking at momentum, profitability, quality, all to build a much richer, more complete picture of a stock's risk and what you should expect to earn from it. And so, here we are, full circle. The grand quest for one perfect number to measure risk led us to the powerful realization that risk is just far too complex for that. Beta wasn't the final answer, but its incredible story, its rise, its dramatic fall, and its comeback forced everyone to ask much better questions. And that really leaves us with a final thought for you, the investor. If there is no single perfect measure of risk, how should you think about the future of your own investments? What factors really matter most when you decide to take a risk in search of a reward? Here's a question for you. Why do so many smart people, and yeah, I'm probably talking about you, make such terrible investment decisions? It's a puzzle, right? We're always told investing is all about logic, numbers, and making rational choices. But what if I told you the single biggest threat to your financial future isn't a market crash or a bad stock tip, but the very wiring inside your own head? Today, we're going to crack open the psychology of investing and find out who the investor's real worst enemy is. So here's our game plan. First, we're going to completely tear down the myth of the perfectly rational investor. Then we'll dive deep into the hidden biases in our brains and the absolute dangers of following the crowd. We'll look at why even the professionals, the so-called smart money, can't seem to fix these problems. We'll pinpoint the common mistakes we all make, and then, this is the important part, we'll lay out a clear, simple strategy for winning what a lot of people call the loser's game. All right, let's jump right in. For decades, traditional finance was built on this one core idea, that investors are basically like computers, rational, logical. But there's a newer and frankly, a much more realistic way of looking at it, and it tells a very, very different story. And this slide just lays out the two sides of the argument perfectly. On one side, you've got the old school, the efficient market theory. It basically says, sure, some people might do dumb things, but in a big market, all that craziness is just random noise. It all cancels out. Any real mistakes get cleaned up fast by the smart, rational pros. But then, in the other corner, you have behavioral finance. And it argues that we're not just a little irrational, we are predictably irrational. Our mistakes aren't random at all. They follow patterns, and those patterns are powerful enough to move entire markets. Okay, so if we're not these perfect, logical robots, what is going on up there in our heads? Let's take a look at a few of the psychological traps that are hardwired into our thinking. And listen, these aren't character flaws. They're just features of being human. But in the world of investing, man, they can cost you a fortune. Get a load of this, 90%. What is that? That's the percentage of drivers who think they are better than average. Now, you and I both know that's mathematically impossible, right? But we all believe it. This isn't just about being behind the wheel. This is about a deep, fundamental human bias. It's called overconfidence. In investing, overconfidence is pure poison. It's that little voice in your head that says, I can pick the winners. I can time the market. It leads us to trade way too much, chasing that thrill, that feeling of control. But that feeling is an illusion. Researchers have studied this, and they found a direct link. The more people traded, the worse the returns were. It's because we remember our one big score and conveniently forget all the little losses. We think our wins are skill, and our losses are just bad luck. That's overconfidence talking. All right, let me introduce you to someone. This is from a classic experiment in behavioral finance. Just read this description of Linda. Take a second. Build a picture of her in your mind. You got it? Now, looking at that description, which of these two statements feels more likely to be true? Just go with your gut. If you're like most people, and I mean over 85% of people, you pick B. It just fits the story, right? But here's the thing. It's a logical trap. It's impossible. Think about it. The group of all bank tellers has to be bigger than the smaller, more specific group of bank tellers who are also feminists. This little trick exposes our second huge bias. We are absolute suckers for a good story, and we often mistake a story that feels plausible for one that's actually probable. This one is a biggie. It's at the core of maybe the most powerful bias we have.
Psychologists have found that the pain of losing, say, $100 is 2.5 times more powerful than the pleasure you get from gaining $100. This is called loss aversion. It's why we do completely irrational things like hold on to a losing stock for years just hoping it'll come back. The idea of selling and making that loss real is just too painful. So we'd rather stick our heads in the sand, even if it's the worst financial move we could make.
So we've got these glitches in our own individual thinking. Overconfidence, storytelling, loss aversion. But what happens when you take millions of these biased brains and throw them all together into a marketplace? Well, that's when a few sparks of irrationality can turn into an absolute bonfire. Individual quirks amplify into collective madness. To really get this, look at this famous experiment. You've got a person in a room with 6 other people who are all actors. They're shown a card with some lines on it and asked a super simple question. Which line on the right matches the one on the left? The answer is obvious. A child could get it right. But then, one by one, all the actors confidently give the wrong answer. By the time it's the real person's turn to speak, you wouldn't believe how many of them just go along with the group, agreeing with something that is clearly, obviously wrong. That's the power of social pressure. This simple test shows you how contagious this stuff is in the real world. One person looking up at the sky, a few people might glance over, but get 15 people to stare up at the sky, suddenly almost half the people walking down the street have to stop and see what's going on. And you know what they're all looking at? Absolutely nothing. That is herd behavior. And in investing, when we see a bunch of people making money on something, we feel this incredible pull to join in, not because we know anything, but because we're terrified of missing out. And man, this quote just nails it. It perfectly captures the emotional engine that drives market bubbles. It's not about the fundamentals. It's not about the PE ratios. It's about envy. It's about seeing your neighbor or your brother-in-law bragging about how much money they're making on some hot stock. And suddenly your rational brain just switches off and that herd instinct takes over. That feeling is the fuel for every speculative mania in history. But hang on a second. What about the professionals? Shouldn't the hedge funds and the big Wall Street players, the smart money, see all this irrational nonsense and bet against it? Shouldn't they be the ones to bring the market back to sanity? Well, that's what the theory says. But in the real world, it's just not that easy. The process of fixing these market mistakes is called arbitrage. The idea is that these rational traders, who are like the market's cleanup crew, will sell the overpriced junk and buy the underpriced gems, and in doing so, pull everything back to its fair value. It sounds fantastic on paper, but in reality, there are some pretty serious limits to how well it works. And this brings us to a saying on Wall Street that you really need to remember. The market can remain irrational longer than you can remain solvent. The dot-com bubble is the perfect, painful example. Any rational trader in 1999 knew that internet stocks were insanely overpriced, so they bet against them. But the herd just kept pushing prices higher and higher. And those rational traders, they got wiped out. They lost everything long before the bubble finally popped in 2000. In fact, a lot of the pros didn't even try to fight it. They just jumped on the crazy train with everyone else, hoping they could get off before it went over the cliff.
Okay, so now we get it. We understand the biases in our own heads and the herd mentality that drives the market. So let's connect the dots. Let's look at the specific, self-destructive behaviors, the stupid investor tricks that this psychology causes us to fall for again and again.
Think of this as your checklist for not being the sucker at the poker table. IPOs, they're exciting. They get all the headlines, but the data shows that after the initial hype, they usually underperform. Those hot tips you hear, they're playing on your desire for a shortcut, but they're almost always garbage. Foolproof schemes, like Bernie Madoff promising steady 12% returns year after year, that's a giant red flag. And that last one, that's a golden rule. Urgency, high pressure, those are the tools of a salesman, not someone who has your best interests at heart.
All right, so we've identified the enemy, and as the old cartoon character Pogo famously said, it is us. But this isn't about giving up. In fact, it's the opposite. Understanding your own psychology is the most powerful weapon you can have. So let's talk about how to turn this knowledge into a winning strategy. And this chart, man, this chart says it all. It shows you the price of getting it wrong. The bars show money flowing into and out of stock funds. Look at the peaks, like in 2000, when the market's flying high, that's when the public piles in, buying at the top. And then look at the troughs, the bottoms, like in 2002 and 2008, that's when fear is rampant and everybody pulls their money out, selling at the low. It's the perfect recipe for destroying your own wealth.
So, how do you win this game? The secret isn't about being a genius. It's about not being a fool. It's about systematically avoiding the big mistakes. First, stay away from the herd. If everyone at the party is talking about a stock, that's your signal to be very, very careful. Second, stop tinkering. As Warren Buffett says, your best approach should be lethargy bordering on sloth. The less you trade, the better you'll likely do. And finally, you have to fight that loss aversion. It makes so much more sense to sell your losers, you get a tax break for it, and let your winners keep on winning.
And this brings us right back to where we started. The biggest risks to your financial life, they aren't on the news, they aren't in the market charts. The most dangerous, unpredictable, and destructive force in your portfolio is the person staring back at you in the mirror every morning. Your own impulses, your own biases, your own emotions, that's the enemy you have to conquer. So the question I want to leave you with is this. Now that you've seen the playbook for how your own mind works against you, what are you going to do about it? Are you going to make a rule to trade less? Are you going to promise yourself you'll never buy a stock you heard about at a barbecue? See, understanding all this isn't just some interesting mental exercise. It is the first, most critical step toward actually building long-term wealth. So how are you going to use it?
Welcome to this explainer. For years, you've heard the same advice, right? Just buy a simple, low-cost index fund and call it a day. It's been the undisputed champion. But what if there's a better way? What if there's a smarter way? Today, we are tackling a massive question. Can you actually beat the market without being a genius stock picker? We're going to put 3 of the biggest new challengers, strategies that have already pulled in hundreds of billions of dollars, right under the microscope. I just love this quote from Edison. It's perfect for what we're talking about. Because, Wall Street is kind of like Edison's old lab. It is constantly cranking out new, shiny, and super complex inventions. So we're going to take a page out of his book today. We're going to apply a healthy dose of skepticism and figure out if these new strategies are the real deal or just a few more things that sound great but ultimately don't work.
So this is the big promise, isn't it? This is the core claim of all 3 strategies we're digging into today: smart beta, risk parity, and ESG. Every single one of them says, hey, we can do better than just buying the whole market. But they all have a completely different way of trying to get there. It's a really compelling idea, so let's get into our first contender and see what it's all about. First up, we've got smart beta. The main idea here is pretty simple. That standard way of indexing, where the biggest companies just get the biggest piece of the pie, well, they say that's not the best recipe. The folks behind smart beta argue that if we just add a little flavoring, if we tilt the portfolio in certain ways, we can cook up something a whole lot better. Okay, so what is this flavoring they're talking about? The key is that this is not about some fund manager's gut instinct. No. It's all based on rules. The strategy systematically tilts your portfolio toward things that academics call factors or risk premiums. Basically, a risk premium is the extra return you'd hope to get for taking on a specific kind of risk that other people are avoiding. The goal is to get a better return for the amount of risk you're taking. So let's check out the most popular flavors in the Smart Beta Cookbook. The first flavor, and probably the most famous, is value. I mean, this is the gospel preached by legends like Warren Buffett. The theory is actually beautiful in its simplicity. It says that stocks that are cheap compared to their actual business fundamentals, things like earnings or book value, tend to do better over time than the expensive, flashy growth stocks. The idea is that we all get a little too excited about the next big thing, and we overpay, leaving some real bargains on the table. And this isn't just some old story. The historical data is incredibly strong. Just look at this chart. What's so amazing here is how clear the pattern is. On the far left, you've got the cheapest stocks, the ones with the lowest price-to-earnings ratios. And look, they delivered the highest average returns by a mile. Then, as you move to the right, as the stocks get more and more expensive, the returns just step down, down, down. It's a pretty powerful picture. All right, our next flavor is size. For a long time, researchers have spotted this other weird pattern in the market. On average, smaller companies tend to generate bigger returns than their huge, well-known cousins. Now, this probably isn't a free lunch. The thinking is that the extra return is basically your payment for taking on the extra risk that comes with smaller, maybe less stable businesses. And this chart just nails the point. It's a classic from the researchers Fama-French. So what they did was slice the whole market into 10 buckets based on size. That first bucket on the left, decile 1, holds the smallest 10% of companies. And would you look at that? It had the highest average monthly returns, by a lot. As you move to the right, all the way to the giant companies we all know, the returns get smaller. The pattern is just
really hard to ignore. Now, this third flavor is a little strange. It almost seems to defy common sense. It's called momentum, and it's based on a super simple observation. Winners keep winning, and losers keep losing, at least for a little while. A stock that's been on a hot streak is statistically more likely to keep doing well. This idea kind of flies in the face of the whole markets are random theory. And what's wild is that our source material notes that, historically, this has been the most powerful factor of them all. Okay, so you've seen all this powerful academic research, and you've got to be thinking, what's the catch? Well, this is where reality comes crashing in. The promise of higher returns is great, but in the real world, a lot of these funds have actually underperformed a plain old market index, especially over the last decade. Plus, they usually come with higher fees and can be worse for your taxes. It turns out, once an idea gets really popular and billions of dollars rush in, the very thing you were chasing tends to, well, shrink. All right, let's shift gears and look at our second challenger. This one takes a totally different path. It's called risk parity, and it was made famous by the billionaire Ray Dalio and his firm's legendary all-weather fund. This strategy doesn't just want to add a little flavor to the recipe, it wants to rewrite the whole cookbook. The whole idea behind risk parity is built on this really fascinating and kind of counterintuitive idea about us as investors. We tend to overpay for the exciting lottery ticket type investments, right? Meanwhile, the safer, more boring stuff often gives us a better return than it really should for its low risk. So risk parity says, well, why don't we take those safe assets like government bonds and use leverage, that's borrowed money, to crank up their risk and return to match stocks? The best way to get your head around this is with an analogy. Imagine you're at a horse race. Betting on the long shot is a huge thrill. You could win big. But statistically, over time, you're going to lose more money that way. Betting on the favorite, on the other hand, is not nearly as exciting, but it's a better bet. You lose less over the long haul. Risk parity takes that exact logic and applies it to investing. It says you're better off taking the favorite, the safer asset, and leveraging it up than you are chasing the risky long shot. Okay, let's see how this actually works with some real numbers. This table shows what happened between 2007 and 2016. The S&P 500 gave you about 8.6% per year, with a standard deviation, which is just a fancy way of saying how bumpy the ride was, of 2.0. A boring old treasury bond, it returned 5%, but with way less risk, only 0.8. But now, look at that last line. By borrowing money, you could have theoretically juiced that bond's return to over 10%, beating the stock market with less risk. That right there is the powerful appeal of risk parity. But, and believe me, this is a huge but, the whole strategy has a massive weak spot. It relies on leverage, which can be absolutely brutal when things go bad, and it relies on bonds doing well. For 40 years, basically from the early 80s until just recently, bonds were on this incredible, once-in-a-lifetime winning streak as interest rates just fell and fell. That was the perfect fuel for this kind of strategy. But that party is over. And the reality is, the famous all-weather fund has actually underperformed a simple balanced indexed fund. And that brings us to our third and final challenger. And this one is, without a doubt, the most popular new strategy on the planet, ESG investing. That stands for environmental, social, and governance. The whole mantra here is that you can do well by doing good, that you can line up your money with your values and maybe even get better returns because of it. And I need you to understand, this is not some tiny niche thing. Just look at that number, $50 trillion. That's the amount of money that's expected to be invested using ESG principles by 2025. We're talking about more than a third of all the professionally managed money in the world. This is a seismic shift in how money is moving around the globe. But right away, we hit a big problem. What exactly is a good company? It turns out defining that is incredibly subjective, and this slide shows it perfectly. These are the big agencies that rate companies on ESG stuff, and they just can't agree. One firm, Refinitiv, gives Apple a great score, 73 out of 100. But then another one, S&P Global, gives it a terrible score, just 23. So if the experts can't even agree if Apple is good or bad, how are the rest of us supposed to figure it out? And the confusion doesn't stop there. When you actually look inside some of the biggest ESG funds, you find some interesting companies. I'm talking about Google's parent company, Alphabet, Meta, Facebook, Visa. All of these companies have been at the center of their own major controversies. And this whole situation has led to this thing called greenwashing, where a company just slaps a green label on itself without really changing anything. So let's just cut right to the chase here. Does ESG investing actually make you more money? The promise is that you can have it all. But the reality, based on our source material, is that there's just no credible evidence that it leads to better returns over the long run. In fact, there's a pretty strong argument that it might actually lead to lower returns. Think about it. It's simple supply and demand. As tons of money chase a few good stocks, their prices get pushed up. And a higher price today just mathematically means a lower expected return tomorrow. Okay, so we've taken a hard look at smart beta, risk parity, and ESG. We've investigated their promises and their pitfalls. After putting these three giants under the microscope, what's the final verdict for someone who's just trying to find a better mousetrap? Well, the evidence we've looked at today is pretty clear. None of these strategies have proven to be that magic bullet we're all looking for. The core of your portfolio should probably be what it's always been, a simple, cheap, broad-based index fund. These other ideas, they aren't free lunches. They are complex, they're more expensive, and they bring their own hidden risks to the table. If you're going to dabble in them, you should probably treat them like a little bit of spice on the side, not the main course.
And that really leaves us with this one big question to think about. Are these strategies a true evolution, a smarter way to invest? Or are they just the same old Wall Street game, dressed up in a new, more complicated, and more expensive package? It's a question worth asking yourself before you jump off the well-worn path for the promise of a shortcut. Thanks for joining this explainer.
All right, let's get into it. Today, we're going to look at personal finance a little differently. We're going to treat it like personal fitness. Think of this as a complete workout plan, a financial fitness manual, really, designed to get your portfolio into top shape. And look, this isn't about some get-rich-quick sprint. This is all about building the endurance you need for a lifelong financial marathon. So, let's get warmed up.
You know, this quote from J. Kenfield Morley, it just nails the central problem, doesn't it? It's the big dilemma every single one of us has to deal with as an investor. Are you the type to chase after the biggest, juiciest returns, even if it means you're chewing your nails with anxiety? Or do you put a higher price on peace of mind, knowing your money is safe and sound? The whole plan we're building today, it's about finding your perfect balance between eating well and sleeping well.
So here's our workout for today. First, the warm-up. We're going to secure your financial base. Then we'll move into how to maximize every single dollar you save. After that, we get personal and find your sleeping point to really lock in your strategy. Next, we'll get into the nitty-gritty of building a resilient portfolio that can last. And finally, we'll talk about how to stick to the plan and avoid all those costly detours that can trip you up.
All right, let's dive into our first exercise, securing your financial base. This is your financial warm-up. I mean, think about it. You wouldn't just walk into a gym and try to lift the heaviest weight, right? You'd get hurt. It's the same thing here. You can't start investing aggressively until you've got a solid foundation. This is all about getting ready for the road ahead.
You know, let's just cut through all the noise for a second. So many people think the secret to getting wealthy is picking the next Amazon or finding some genius with a crystal ball. But the reality, the actual, harsh truth, is way, way simpler, and it's 100% in your control. The single most important factor for your financial success is your savings discipline, period. If you don't have a regular savings plan, it doesn't matter how great your returns are. This right here is the bedrock of everything.
So why is starting early so unbelievably important? Just look at this number. This is the insane magic of compound interest. A guy named Jeremy Siegel did the research. If you had invested a single dollar in the stock market way back in 1802, by 2021, it would have turned into $54 million. No, that's not a typo. That's what happens when your returns start earning their own returns over 2 centuries. The lesson? Trust time in the market, not timing the market.
Okay, before we even think about growing your wealth, we have to protect it. Because life happens, right? The furnace dies in the middle of winter, or a layoff comes out of nowhere. That's why you absolutely need a safety net. First thing, a cash reserve. We're talking at least 3 months of living expenses sitting in a totally safe account you can get to immediately. Then, you need the right insurance. Home, auto, health, and disability, these are just non-negotiables. And hey, if you've got anyone who depends on your income, life insurance is an absolute must.
Now, with life insurance, you're going to hear about 2 main kinds. On one hand, you've got term life. It's simple, it's cheap, you pay a low premium for a set number of years, and if you pass away during that time, your family gets the money. That's it. Then, you've got whole life, and man, this is where things get really complicated. It's this messy bundle of insurance mixed with a high-fee investment thing. The premiums are way, way higher because it's trying to do 2 things at once, and frankly, it usually doesn't do either one of them very well for you.
So what's the bottom line here? It's pretty simple.
For the vast majority of us, the smart move is to buy the cheap, straightforward term insurance to cover your needs. Then, you take all that money you just saved on the crazy high premiums, and you invest it yourself in a good retirement account. Trust me, this DIY approach almost always leaves you with more protection and a bigger pile of money in the end because you're not feeding the beast of high commissions and hidden fees.
Okay, let's move on to our second exercise. This is where we start optimizing the workout, so to speak. It's all about maximizing every dollar. Once you've got the savings habit down, the very next step is making sure that every single dollar you put away is working as hard as it possibly can for you. And its biggest enemy? Well, that's the tax man.
This chart, it just says it all, doesn't it? Look at this. Both bars represent someone saving $6,000 a year for 45 years, earning a 7% return. The bar on the left, that's what happens in a regular taxable account. You end up with about $1 million. Not bad. But look at the bar on the right. That's a tax-deferred IRA. Just by letting your money grow without the government taking a piece every single year, the final number is almost $1.8 million. That's an $800,000 difference, just by using the right kind of account. It's huge.
Now, inside the world of IRAs, you've got this really key choice to make. It's the old jam today or jam tomorrow question. A traditional IRA gives you jam today. You get a nice tax deduction right now, which feels pretty good. The catch is you have to pay taxes on all that money when you take it out in retirement. A Roth IRA is the opposite. It's jam tomorrow. You don't get a break on your taxes today, but the incredible payoff is that all of your withdrawals in retirement, all the growth, everything is 100% tax-free. The right choice really just depends on if you think you'll be in a higher tax bracket now or later in life.
So here's a quick rundown of the best tools you have in your tax-fighting toolkit. You've got your IRAs, which we just talked about. If your job offers a 401k or a 403b, that's fantastic, especially if there's a company match. That is literally free money. You have to take it. If you're self-employed or even have a side gig, you can open a SEP IRA and save a ton. And for the kids' education, a 529 plan is amazing for tax-free growth. Using these is how you legally and smartly keep more of your own money.
All right, time for exercise number 3. Find your sleeping point. Now this is all about creating an investment strategy that is tailor-made for you. Not your brother-in-law, not some guy yelling on TV, you. It's amazing how many people just skip this step. They either take on way too much risk and then panic sell at the worst possible time, or they're so scared they take on no risk and their money never grows. This is about knowing yourself.
So, how do you figure out how much risk you can handle? Let's try a little thought experiment. Think back to when you were a kid playing Monopoly. What was your move? Were you the plunger? The one who saved every last dollar to buy Boardwalk and Park Place, going for that one massive game-ending score? Or did you prefer the steady, reliable cash flow from the orange properties? You know, St. James, Tennessee? They weren't flashy, but man, people were always landing on them. Your answer there tells you a lot about your natural gut feeling towards risk.
And that brings us to this brilliant concept from the legend himself, J.P. Morgan. The story goes, a friend came to him, a complete wreck, couldn't sleep because he was so worried about his stocks. Morgan's advice was just perfect. He said, sell down to the sleeping point. And that's what it is. Your sleeping point is the amount of risk you can take on and still put your head on the pillow at night and actually sleep. It is the single most important benchmark for building a portfolio you can live with for the long haul. And we can even map this out on what I like to call the sleeping scale. See, down at the bottom you have things like money market funds and CDs. The risk is almost zero, and you are going to sleep like a baby. Of course, your returns will be pretty sleepy too. As you move up the scale through bonds and real estate, your potential returns go up, but so does the risk. You might have some occasional bad dreams. Then you get to common stocks, the real engine of growth. And yeah, you have to be ready for some sleepless nights when the market gets rocky. And all the way at the top with aggressive stocks, the potential reward is huge, but you might be signing up for some full-color nightmares. Finding your spot on this scale is absolutely crucial.
So, now that you've figured out your sleeping point, let's get practical with exercise 4, building a resilient portfolio. This is your long-term endurance plan. This is where we stop talking theory and start putting it into practice, building a mix of assets that's going to get you to your goals and, just as importantly, can take a punch when the market gets crazy.
We can really boil down portfolio construction to 3 basic simple steps. Number 1, start at home. For a lot of people, owning their own house is a huge part of their net worth. You can add to that with things called REITs, which lets you own a piece of commercial real estate. Number 2, add stability. That's what bonds are for.
They're like the shock absorbers on your car. They smooth out the ride and the stock market gets bumpy. And number 3, fuel the growth. That's the job of common stocks. Over the long haul, that's where the real returns come from.
But here's a pro tip that a lot of people miss. Diversification isn't just about owning stocks and bonds. You need to diversify within the stable part of your portfolio too. So as you see here, your bond portfolio might have different pieces. You could have some tips to protect you from inflation, maybe some zero-coupon bonds that are set to mature right when you need money for college, some general bond funds for broad exposure, and if you're in a high tax bracket, some municipal bonds to save on taxes. Each one has a specific job to do.
Now here's a bit of a curveball, a more advanced idea. There are long stretches of time when governments intentionally keep interest rates super low. They call it financial repression, and it makes earning money on bonds really tough. In an environment like that, it can actually make a lot of sense to swap out some of your bonds for high-quality dividend-paying stocks. A lot of times, the dividends you get from a solid blue-chip company is higher than the interest on a bond, and you get the chance for that dividend to grow. It's about being flexible and adapting to what the market is giving you.
And that brings us to our 5th and final exercise, avoiding costly detours. Look, this is all about having the discipline to stick with your fitness plan. You can create the perfect plan, but it means absolutely nothing if you get sidetracked by shiny new fads or make dumb mistakes. This section is about learning to ignore the financial junk food.
Let's just be crystal clear about a few things that have no business being in a long-term investment plan. Cryptocurrencies and NFTs? That's the casino, not your retirement account. It's gambling, plain and simple. Collectibles like art or stamps? Hey, buy them if you love them, but do not call them an investment. The costs are huge and the market is tiny. High-cost hedge funds? Warren Buffett famously won a bet that a simple S&P 500 index fund would beat them over 10 years because their insane fees just eat up all your returns. And finally, day trading. Just because commissions are zero now doesn't mean you won't lose all your money, which, by the way, is what happens to most day traders. Just stay away from these sinkholes.
Look, if you take away only one thing today, let it be this. At the end of the day, you have to focus on what you can actually control. You can't control what the stock market does tomorrow. You can't control interest rates. You can't control inflation. Stop trying. But there are 2 huge things that you have total power over. You can control your investment costs by picking low-fee funds, and you can control your taxes by using the right accounts. Focusing on those 2 things will do more for your success than anything else.
So there you have it, a complete financial fitness manual. We've gone through the warm-up, the core exercises, and maybe, most importantly, the things to avoid. The plan is all laid out. The path is clear. The only question left is the one right there on the screen. Your financial workout is planned. Are you ready to begin your walk? Thanks for joining me.
All right, let's dive in. Today, we're going to tackle something that, honestly, can feel impossible. We're going to try and make sense of long-term returns from stocks and bonds. But here's the key. This isn't about gazing into a crystal ball. Not at all. Think of it more like becoming a financial bookie. We're here to learn how to understand the odds, how to handicap the race, and ultimately, how to build a much smarter portfolio for the long haul. Let's get to it.
You know, I really love this quote because it just nails the mindset we need. The whole point here isn't to get stressed out by the market's daily drama. It's about using the past as a lens, a really clear lens, to get a better handle on the present, and more importantly, to help us build a better strategy for the future.
I mean, let's be honest. For most of us, the market just feels like pure chaos, right? It's a whirlwind of headlines and flashing numbers. One day you're up, the next you're down. But what if I told you that underneath all that noise, there are a few simple fundamental rules that have basically governed how this whole thing works for almost 100 years? Well, that's exactly what we're going to pull back the curtain on today.
So, here's the game plan. First, we're going to shift our mindset and learn to think like that financial bookie. Then, we'll get into the surprisingly simple math that drives stock and bond returns. After that, we'll put that theory to the test against 4 completely different periods in history. Then, we'll bring it all home and apply it to today to handicap what might be coming. And we'll wrap up by talking about the huge difference between understanding the odds and foolishly trying to predict the future. Okay, Section 1, Becoming a Financial Bookie. Now, this is such a critical mental shift. A good bookie doesn't walk around pretending to know exactly which horse is going to win the race. No way. What they've mastered is the art of calculating the odds. They study everything, past performance, the condition of the track, all the key variables. And that is exactly what we need to learn to do as investors.
Right, so this is so important. We are officially giving up the game of trying to guess what the market's going to do next week, next month, or even next year. That is a fool's errand.
Our focus is going to be laser sharp on understanding the real drivers that let us project a range of likely outcomes over the long term. This is the bedrock you can build a real, durable financial plan on.
So in Section 2, we're going to pop the hood and see how this engine really works. And I think you'll be surprised. The machinery that drives long-term returns, it is not nearly as complicated as Wall Street might want you to believe. In fact, we can boil it down to a really simple two-part formula.
And there it is. Seriously. Over the long haul, your total return from stocks really comes from just two things: the dividend you're getting when you buy in, plus the rate that the companies actually grow their earnings and dividends over time. That's the whole shebang. And check this out. From 1926 all the way to 2022, the market's average return was about 10% a year. And guess how that breaks down? Almost perfectly. An average of 5% from the initial dividend yield and 5% from growth. It's simple, it's elegant, and it's incredibly powerful.
Okay, so if it's that simple, you're probably asking, why does the market feel like a roller coaster? And that's because of this, the wild card, valuation. This is all about human emotion. It's about investor sentiment. It's the price people are willing to pay for $1 of a company's earnings. We call that the PE multiple. When people are feeling optimistic, that multiple expands and boom, returns get a massive extra kick. But when people get scared, it collapses, and returns can get crushed even if the actual businesses are doing great. This is the single biggest key to understanding those wild, decade-long swings.
Now, what about bonds? Well, thankfully, bonds are a whole lot simpler. If you buy a bond and just hold it till it matures, your total return is going to be almost exactly the yield to maturity you saw on the label when you bought it. There's no wild card. There's no sentiment factor. It's just a much more predictable ride. And that reliability is precisely why bonds are such a critical part of a balanced portfolio. They act like a steady anchor when the stock market's mood swings all over the place.
Okay, so now we have our toolkit, right? We've got yield, we've got growth, and we've got that all-important PE wildcard. So now the fun part begins. In Section 3, we're going to put on our financial historian hats, and we're going to test drive this framework across 4 very dramatic, very different eras in market history, and just see how well it explains what happened.
And here they are. We're going to start right after World War II, in what we'll call the Age of Comfort. Then we'll dive into the messy, turbulent Age of Angst. We'll ride the incredible wave of the Age of Exuberance, and then we'll see what happens when it all comes crashing down in the Age of Disenchantment. Let's see how our formula holds up.
Let's just break down that first era, the Age of Comfort. Coming out of the war, people were still terrified of another Great Depression, so they just weren't willing to pay much for stocks. The result? You could get a massive starting dividend yield of 5%. Then, the post-war economy just took off like a rocket, delivering about 7% in earnings growth, and on top of that, as people started to feel more optimistic, that PE multiple, the sentiment wildcard, started to expand, giving you another boost. You add those 3 things together, and you get these incredible 14% annual returns.
Now look at the story across all 4 eras. It's fascinating. In the Age of Angst, company earnings were actually growing like crazy. But runaway inflation had everyone spooked, so PE multiples collapsed, and that just killed returns. Then, the complete opposite happened in the Age of Exuberance. Despair turned into total euphoria. Inflation came down, PE multiples shot to the moon, and good returns became once-in-a-generation returns. And then, of course, the dot-com bubble burst, PEs came crashing back to earth, and we got the lost decade. See the pattern? In every single case, the real drama, the deciding factor, was that PE wildcard. It was all about investor psychology.
And this is just perfect. This line from Casablanca perfectly captures what happened in that Age of Angst. Returns were awful, so what did everyone do? They rounded up the usual suspects. They blamed weak earnings and poor dividends. But if you look at the data, earnings were actually growing faster than inflation. The real culprit, the smoking gun, was the collapse in what people were willing to pay for those earnings. It wasn't the economy that tanked the market, it was fear.
So that brings us to Section 4. We've seen the framework works, we've stress-tested it against history. Now, let's do what we came here to do. Let's use it to handicap the future by taking a hard look at our own recent past and what it might mean for the years ahead.
So, from the bottom of the 2008 crisis all the way up to early 2022, investors were on an absolutely incredible ride. I mean, returns of almost 17.5% a year. And, just like we saw in history, that was driven by a solid comeback in company earnings, but, crucially, it was supercharged by that PE multiple expanding. Sentiment went from the absolute depths of despair to sky-high optimism. And that leads us to the billion-dollar question. Can that keep going?
Okay, now this slide right here is probably the most important one of the day, so pay close attention. History shows a very, very clear relationship. When you start a decade from a point of really low valuations, when stocks are cheap and PE multiples are in the bottom 10%, your average return for the next 10 years is amazing. We're talking 15% or more. But when you start from a point of really high valuations in that top decile, well, your future returns tend to be pretty mediocre, 5% or even less. So, where were we in early 2022? With a PE multiple over 35, squarely in that most expensive, highest decile.
And this chart just lays it all out visually. It tells the whole story. On the left, you have that long-term historical average return, around 10%. In the middle, you see the rocket fuel we've been running on, that incredible 17.5% we just experienced. But then you look to the right. That's the forward projection, based on those fundamental drivers we've been talking about, and it comes out to around 6%. Now look, that's not a catastrophe, not by a long shot, but it is a completely different world than what investors have gotten used to.
And that brings us to our final, and maybe most important section, the peril of prediction. Because we have this incredibly powerful framework for understanding the odds, but we have to be so careful not to confuse that deep understanding with some kind of magical ability to know exactly what's going to happen.
I just have to share this little story from the source material. It's so good. An investor gets a magical gift, tomorrow's newspaper. He is ecstatic. He stays up all night mapping out all the perfect trades he's going to make to become unbelievably rich. And then, just as the sun is coming up, he casually flips to the back of the paper, and he finds his own obituary. It's the ultimate cautionary tale, right? Even with what seems like perfect information, the future has surprises in store that we can never, ever account for.
And so we're going to end on that question. The goal today was not to hand you a crystal ball. It wasn't to give you tomorrow's newspaper. It was to give you a framework, a set of tools to understand the fundamental forces at play, to help you set realistic expectations, and to build a long-term strategy that's based on probabilities, not on predictions. Because in the end, knowing that you can't predict the market is the very first step towards preparing for it wisely. Hello everyone. Today we're diving into something that really hits home for all of us, how to make your money work for you. And the secret, as you're about to see, isn't finding some magic stock tip, no. The real key is understanding that your investment strategy has to evolve right alongside you as you move through life. It's not static. So, are you ready to build a financial plan that actually fits who you are right now and in the future? Let's get into it. You gotta love Mark Twain. He just had this incredible way of cutting right through the noise, didn't he? This quote is the perfect frame for our entire conversation because it's all about risk. What you can afford to risk, not just financially, but emotionally, changes so much over your lifetime. A smart, calculated risk when you're 30 might be a totally reckless gamble when you're 70. So the real question is, how do you know when to press the accelerator and when to ease off the gas? And before we even start drawing that roadmap, let's talk about the engine that's going to power this whole journey. You know, we get so obsessed with finding the next Amazon or the next Tesla. But the research is crystal clear. Over 90%, think about that, over 90% of your investment returns have nothing to do with picking individual stocks. It's all about your overall asset allocation. It's like building a house. You can obsess over the paint colors and the fancy faucets, but if the foundation is cracked, none of it matters. Asset allocation is that foundation. So here's how we're going to tackle this. Think of it as a journey through your entire financial life. First, we'll cover the big idea, the financial life cycle itself. Then we'll get you geared up with 5 essential rules of the road. After that, we'll dive into the accumulation phase, building that nest egg. Then we'll talk about shifting gears as retirement gets closer. And finally, the really crucial part, making sure that money lasts. So let's get on the road.
Okay, so the big idea here is actually pretty simple. Your single most powerful investing tool isn't a stock picking algorithm. It's your age. Or, to be more precise, it's your time horizon. Just picture it. You've got a 34-year-old just hitting her peak earning years. She has decades of paychecks ahead of her to recover from any market downturns. Now contrast that with a 68-year-old who's already retired and relies on his investments to pay the bills every single month. Their ability to stomach risk isn't just different, it's on a completely different planet. And that single distinction, well, it's the bedrock of everything we're going to talk about today.
So with that in mind, how do we actually build a strategy that works for both the 34-year-old and the 68-year-old, and for you, wherever you are on that spectrum? Well, the source material gives us 5 foundational principles. Think of them as the rules of the road for our financial journey. Getting these down will guide every single decision we make from this point forward. Let's just quickly run through them. First, a classic. There's no such thing as a free lunch. If you want the shot at higher returns, you have to accept more risk. They're two sides of the same coin. Second, as we just talked about, risk isn't a fixed thing. It changes depending on your time horizon. Third and fourth, we're going to get into two amazing discipline techniques, dollar cost averaging and rebalancing, that help you manage risk without letting fear or greed take the wheel. And finally, number 5, and this one is so important, knowing the difference between your attitude toward risk, how you feel about it, and your capacity for risk, what you can actually afford to lose. We'll unpack all of these as we go.
All right, let's start where the magic happens, the wealth-building years, your 20s, 30s, and 40s. This is the accumulation phase. Your number one goal is growth, and your greatest ally is time. You have decades to let the incredible power of compounding do its work and to ride out any of the market's crazy mood swings. Seriously, it's like planting an oak tree. The sooner you get that seed in the ground, the more time it has to grow into something truly massive.
Now, of course, when you talk about growth, the conversation immediately turns to stocks. And that brings up a really common fear and a totally fair question. We see the headlines about market crashes, we hear about all the volatility, and it's only natural to ask, wait a minute, are stocks just too much of a casino for my life savings? So let's look past the fear and see what the actual data says.
Okay, now this slide is just fascinating. It shows you the power of time in one simple picture. Look at that one-year holding period. The results are all over the place. You could be up a massive 52%, or you could be down a gut-wrenching 37%. That is the kind of wild ride that causes sleepless nights for sure. But now, just shift your eyes over to the 25-year holding period. Look at how much that range of outcomes tightens up. It's a brilliant illustration that while stocks are incredibly volatile day to day, that risk, that volatility gets smoothed out dramatically over the long haul. Time literally tames the risk.
And if you need any more convincing, check this out. This data goes all the way back to the early 1800s. Over any single year, stocks beat safer bonds about 60% of the time. You know, better than a coin flip, but you wouldn't bet your life on it. But stretch that timeline out to 30 years, which is a pretty standard career for saving for retirement, and stocks have beaten bonds 99.4% of the time. Just let that sink in. For long-term goals, history has a clear winner. It's not even close. It's like betting on a horse that has won 994 out of its last 1,000 races. Which horse are you going to bet on?
So, if we know that stocks are the long-term engine, how do we invest in them without driving ourselves crazy trying to time the market? Well, one of the most powerful and simple techniques is called dollar cost averaging. And the great thing is, if you have a 401k, you're probably already doing it. By just investing a fixed amount, say $500 every single month, you completely remove emotion from the equation. You're not guessing, you're not panicking, you're just consistently buying. And the beautiful byproduct is that your money automatically buys more shares when prices are low and fewer shares when they're high. It's a simple discipline that is incredibly effective.
I absolutely love this quote from Warren Buffett because it flips your entire perspective on market crashes. He once said to think of it like you're a lifelong hamburger eater. If you know you're going to be eating hamburgers for the next 30 years, do you want the price of ground beef to go up or down? You want it to go down, of course. It's the exact same thing with stocks. If you are in your saving years, a market downturn isn't a crisis, it's a sale. It's a Black Friday event for your future retirement. It's your chance to buy your future financial freedom at a huge discount.
Now that buy the dip mentality is absolutely the right way to think when you have decades ahead of you. But as we get into our 50s and early 60s, the game starts to change. It's time to start shifting gears. Why? Because your time horizon is getting shorter. You just don't have as much time to recover from a big market hit. So the focus has to slowly pivot away from all-out growth and more towards protecting what you've built. Think of it like a pilot on a long flight. For hours, you're at cruising altitude, but as you approach the airport, you start your gradual, careful descent.
And one of the most important instruments on your dashboard during this descent is rebalancing. It sounds complicated, but it's really not. Let's say your ideal mix is 60% stocks and 40% bonds. Just think of it as a recipe. But after a great year for stocks, your portfolio might have drifted to 70% stocks and 30% bonds. Well, now your portfolio is a little spicier, a little riskier than you intended. Rebalancing is just the simple disciplined act of selling some of those stocks that went up and using the cash to buy more bonds to get back to your original 60-40 recipe. It keeps your risk level right where you want it.
This is such a perfect way to think about it. I mean, we all dream of having that crystal ball, that genie in a bottle who can just tell us, okay, sell now, it's high. Okay, buy now, it's low. Well, rebalancing is the closest thing we have to that in the real world. It's not magic, it's just discipline. It's an automatic system that forces you to trim your winners after they've had a great run, which is selling high.
and forces you to buy more of the assets that have been beaten down, which is buying low. It's your own personal financial genie.
And hey, this isn't just a nice theory. Look at the numbers on this slide. This is amazing. Over a 20-year period, the portfolio that was rebalanced didn't just have less volatility, meaning fewer heart-pounding moments for the investor. It actually ended up with a slightly higher return. Now think about that. You took less risk and made more money. That's because you were systematically forcing yourself to sell high and buy low. It is the closest thing you will ever find to a free lunch in the world of investing.
Okay, so the plane has landed, the ship is in the harbor, you've worked for decades, you've saved, you've invested, and you've built this incredible nest egg. The mission is complete, right? Well, not quite. Now comes the next critical phase. How do you make that money last for the rest of your life, which could be 20, 30, even 40 years? This is the distribution phase, and it's a whole new ballgame.
Now, when it comes to generating that retirement paycheck, you've basically got two main paths. The first is to buy an annuity. Think of it like buying your own personal pension. You hand a lump sum of money to an insurance company, and they promise to send you a check every month for the rest of your life. The huge pro there is security. You can't outlive your money. The cons? They can be expensive and really inflexible. The other path is the do-it-yourself method. You keep control of your portfolio and you draw an income from it. That gives you tons of flexibility, but it also means you're responsible for making sure the money lasts. You're in the driver's seat.
So if you're going to be in that driver's seat, you need a safe speed limit to make sure you don't run out of fuel halfway through your trip. And this is where a safe withdrawal rate comes in. Now, the old rule of thumb used to be 4%, but given that interest rates and expected returns are lower these days, the source material suggests a more conservative number, and that number is 3.5%. Let's dig into why that number is so powerful.
Here's the simple and really beautiful math behind the 3.5% solution. Imagine you've saved $1 million. In your first year of retirement, you withdraw 3.5%, or $35,000, to live on. Now let's assume your portfolio earns an average of about 5% for the year. That's a gain of $50,000. So you've taken out $35K, but your portfolio still grew by $15K. If inflation is running around, say, 1.5%, your account just grew enough to keep up. It preserves your purchasing power. It means you can give yourself a little raise each year to keep up with the cost of living, with a very high probability of never, ever running out of money.
And here's one last fantastic pro tip for this stage. When it's time to raise that cash for your yearly income, which assets do you sell? Stocks? Bonds? The answer is brilliant. You sell whichever part of your portfolio has done the best and has become overweight. So if stocks had a great year and your portfolio is now 65% stocks instead of 60%, you sell stocks to raise your cash. This is genius. You are seamlessly combining your need for income with the discipline of rebalancing. It's an elegant 2-for-1 move. So there you have it. We've gone on a journey through an entire financial life, from those first contributions in your 20s to creating a lasting income in your 70s. But the most important thing to take away from all of this is that this is a framework, a roadmap. It is not a rigid one-size-fits-all prescription. You have to tailor it to your life, your goals, and your own personal comfort with risk. You are the captain of this ship. This has just been our attempt to give you a really, really good map.
So let's just quickly cement the big ideas. 1. Your plan cannot be static. It has to grow and change as you do. 2. Focus on the big picture. Your asset allocation is what truly drives your results, not chasing hot stocks. 3. Embrace time. It is your single greatest superpower as an investor. It turns short-term volatility into long-term opportunity. 4. Discipline will always beat prediction. Systems like dollar-cost averaging and rebalancing work. And 5. When you get there, a smart, conservative withdrawal plan is your ticket to a stress-free retirement.
And we'll leave you with this one final thought. Your financial life is one of the longest and most important journeys you will ever take. The principles we've gone over today, they're the components of a reliable map, a trustworthy GPS. The only question left is, are you using it? Thank you so much for joining me. Here's to a prosperous journey ahead.
You know, a lot of us look at investing and see this chaotic game, right? Something only for the pros on Wall Street. Well, what if I told you the smartest path is actually the simplest one? Today, we're cracking open a legendary book, A Random Walk Down Wall Street, to pull out a philosophy that's worked for 50 years. It really just comes down to 3 giant steps you can take to build real, lasting wealth. Let's jump in.
You know, it really all starts here,
with this incredible line from Charles Dickens. He nailed it. That little gap between what you earn and what you spend. That's it. That's the fuel for your entire financial future. And investing, that's just the engine we use to turn that fuel, that simple savings, into real long-term security. And as we're about to see, the line between financial happiness and misery, well, it can be a lot simpler to navigate than you think.
All right, so here's the game plan. We're going to look at 3 different paths you can take. First, what the author calls the no-brainer. Then we'll get into the DIY investor path. After that, we'll talk about hiring a pro. And we'll wrap it all up with some timeless lessons that honestly work for everyone. Let's get moving.
Okay, path number 1. This is the big one, the one the author recommends above all others. He calls it the no-brainer, and believe me, it's for a very good reason. The whole idea is to be simple, to be effective, and for most of us, it's the most reliable way to capture the market's growth without getting caught up in the madness of trying to outsmart it.
So, what's the magic tool here? It's the index fund. And the concept is beautifully simple. Instead of trying to find the needle in the haystack, that one winning stock, you just buy the whole haystack. You buy a single fund that owns a piece of all the companies in a market index, like the S&P 500. You're not betting on Apple or Google. You're betting on the long-term success of the entire US economy. It's like instant diversification in one shot. So why is this so powerful? I mean, it seems too simple, right? Well, it's because all these little advantages add up to something huge over time. Get this, you get performance that historically beats most of the pros who are paid big bucks to pick stocks. The management fees are practically zero, and because the fund isn't constantly buying and selling, it's super tax efficient. It's a quiet, simple, but incredibly powerful engine for building wealth.
Now, you'll always hear the critics say, oh, that's just settling for average returns. It's guaranteed mediocrity. And on the surface, that kind of makes sense. But here's the kicker. After 50 years of data, the author shows the complete opposite is true. Once you factor in the massive fees and the constant trading costs that active fund managers charge, well, that average return suddenly looks pretty darn good. In fact, it ends up beating most of them year after year.
And what's really interesting is how the author's own thinking has changed over the decades. For a long time, indexing pretty much meant buying an S&P 500 fund. But that's only the 500 biggest companies. It's like only owning the skyscrapers and ignoring the rest of the city. You're missing out on thousands of smaller, faster-growing businesses. So the new advice, the better advice, is to go even broader. Buy a total stock market index. That way you own a piece of everything, from the giants down to the up-and-comers.
And this isn't just a US thing either. You would think, right, that in these trickier, more volatile emerging markets, that's where a smart professional manager would really shine. But the data? It tells a completely different story. It's actually shocking. Over 20 years, a whopping 92% of actively managed funds in emerging markets failed to beat their simple index. 92%. The higher fees they charge just dig a hole that's almost impossible to climb out of.
So, okay, what does this actually look like? Let's get practical. Here's a sample portfolio the author lays out for someone, say, in their mid-50s. And just look at the pieces here. It's not just a big pile of US stocks. You've got your US market, sure, but also developed international stocks, a slice of those faster-growing emerging markets, and even real estate to help fight inflation. And holding it all together is a solid base of bonds and cash for stability. See, this isn't just a list of investments. It's a carefully built financial fortress, designed to stand strong no matter what the market throws at it.
Let's boil that down even further. The easiest way to think about it is this. Roughly half of the portfolio is the engine. That's your stocks and real estate, the stuff that's going to drive your growth over the long run. The other half is the shock absorber. That's the bonds and cash. They're there to smooth out the ride when things get bumpy. Now, those exact percentages will shift as you get older, but that basic idea, balancing the engine with the shock absorbers, that's a timeless rule.
All right, on to path number 2. And this is for all of you out there who just heard everything I said about index funds and thought, nope, that sounds boring. I want to be in the game. Hey, I get it. If you love the challenge, if you've got the time to really dig in, and you can stomach the risk, then this is the do-it-yourself path.
But if you're going to play this game, you got to play by the rules. The author lays out 4 of them. Rule 1, you're looking for companies with real sustained growth. Not just one good year, but 5 or more. Rule 2, and this is maybe the most important, never ever overpay. It's a strategy called growth at a reasonable price, or GARP. Finding a great company is only half the job. Buying it at a smart price is the other half. Rule 3, the company needs a great story, something that can really get other investors excited. And Rule 4, the one that trips everyone up, trade as little as possible. Once you find a winner, just let it run. churning your account is a recipe for high taxes and fees. But even if you follow every single one of those rules, the author gives a huge flashing warning sign, and he puts it in this absolutely perfect quote. Breeding thoroughbred porcupines. I mean, come on. He's not saying you can't succeed, but he's making it crystal clear that this is an incredibly difficult and very risky game to play. Sometimes, even when you do everything right, you're still going to get pricked.
Okay, so maybe path 1 feels a little too hands-off, but path 2 sounds way too stressful. Well, there's a third way, hiring a pro to be your guide. And if you're thinking of some old-school stockbroker in a stuffy office, think again. The whole world of financial advice has been completely turned on its head.
And this really lays it out, doesn't it? The old way versus the new way. You used to have traditional advisors, we're talking fees of 1% or more, huge minimum investments, and sometimes, let's be honest, a conflict of interest if they were earning commissions. But now, you have these automated robo-advisors. Their fees are a fraction of that, like 0.25%. You could start with just a few $100. And they generally have a legal duty to act in your best interest, using the very same low-cost index funds we just talked about.
And one of the coolest things these automated services do is something called tax loss harvesting. It sounds super technical, but the idea is actually pretty simple. When one of your investments goes down in value, the system will strategically sell it to create a tax deduction for you. That loss can then cancel out gains elsewhere in your portfolio. It's a smart, automated way to turn a small loss into a tax-saving win, and it can really add up over time.
So how does it all work? Well, it's actually incredibly slick. You basically fill out a questionnaire online. It helps them figure out your goals and how much risk you're comfortable with. From there, they build you a fully diversified portfolio with those low-cost funds. And then, the software just takes over. It automatically keeps your portfolio balanced. It does that fancy tax loss harvesting we just mentioned. It handles all the complicated stuff in the background while you live your life.
So there you have it, the no-brainer path, the do-it-yourself path, and the path with a pro. But here's the thing. No matter which one you choose, your success is going to come down to a handful of core, timeless ideas. These are the lessons that have worked for 50 years and they'll likely work for 50 more.
And if you want to see just how critical these lessons are, let's look at the ultimate financial stress test, the decade from 2000 to 2009. I mean, think about it. It kicked off with the dot-com bubble bursting and ended with the 2008 global financial crisis. They call it the lost decade because if you had just invested in a U.S. stock market fund at the beginning, 10 years later, you would have had less money than you started with, a total wash.
But, and this is the whole point, look what happens when you apply the lessons. That first bar, that's the U.S. market, a negative return for the decade, a disaster. But that second bar, that's what happened if you owned the simple, diversified portfolio we talked about in Path 1. You didn't just survive the lost decade, you thrived. You would have made 6.5% per year, right through two of the biggest crashes we've ever seen. That, my friends, is the power of diversification.
And that incredible result really hammers home the 4 golden rules. Number 1, diversify. And I mean really diversify, across different types of assets and all around the world. Number 2, rebalance your portfolio at least once a year to keep it on track. Number 3, use low-cost index funds as the solid core of your investing strategy. And number 4, the hardest one for all of us, stay the course. Don't let your emotions, fear, or greed wreck a perfectly good plan.
You know, through all of it, high inflation in the 70s, the dot-com bubble, the housing crash, pandemics, you name it, these simple principles have proven themselves again and again. Look, they're not flashy. This isn't a get-rich-quick scheme. It's just the boring, time-tested, reliable way to build real, lasting wealth.
So let's end our walk here with one final question for you. And these ideas aren't some new fad. They've been working for half a century. So I want you to ask yourself, what is your portfolio really built on? Is it built on chasing hot trends and trying to outsmart everyone else? Or is it built on a simple, durable foundation of discipline and diversification? Is it built to survive the next 50 years?
For the past few decades, a really simple, really powerful idea has completely taken over the world of investing. It's called index fund investing, and it has attracted trillions of dollars from everyday people like you and me. But what if that incredible success is actually planting the seeds of its own destruction? What if this thing we all trust is secretly damaging the entire economy? Well, we're diving into that today, because a shocking critique from the heart of Wall Street claims this beloved strategy might be, and I'm quoting here, worse than Marxism.
So here's how we're going to break down that pretty explosive claim. First, we'll get a handle on just how massive this indexing revolution has become. Then we're going to dig into the two main accusations. Is it breaking the very machinery of the market? And is it creating a new class of all-powerful corporate overlords? And finally, we'll get to what really matters, a clear verdict for you, the investor.
You know, to really understand why this debate is so important, you first have to appreciate the sheer scale of this thing. Passive investing, it's not some small niche strategy anymore. For millions and millions of people, it is the stock market.
And the speed of this takeover is just staggering. Index funds now hold over 40% of all the money in U.S. mutual funds and ETFs. We're talking trillions of dollars that have moved away from the traditional high-paid stock pickers and into these automated funds. It's truly one of the biggest and fastest shifts of money in financial history. And if you want to put that scale into perspective, just look at this number. That's not the total amount in all index funds, that's the assets in a single fund. The Vanguard Total Stock Market Index Fund. At over $1.3 trillion, that one fund alone holds a huge chunk of all U.S. investment assets. So when any single strategy gets this big, you have to start asking some serious questions about what it's doing to the system. And this is where the fight really starts. As index funds became this dominant force, you can imagine the old guard, the active managers who were losing trillions in assets. They decided to fight back. And boy, did they land a punch with one of the most provocative claims you can imagine. Look, this wasn't some crazy blog post from the fringes of the internet. This was a 47-page report from Sanford C. Bernstein, a really well-respected Wall Street research firm. And their argument, at its core, was that a system where everyone just passively buys the whole market is actually worse for capitalism than a centrally planned economy. What a statement. It's designed to make every single one of us stop and ask, wait a minute, could they actually have a point? So that whole worse than Marxism thing, it really boils down to two big fears. The first is all about market mechanics. The idea that indexing is basically breaking the system that figures out what companies are actually worth. The second one is about power. The fear that we're accidentally handing over control of every major corporation to just a handful of firms. Let's tackle that first one, the market mechanics.
All right, this first argument is a really interesting little puzzle. It basically says that the more popular indexing gets, the more it eats away at the very foundation that allows it to work in the first place. Just think about it for a second. An index fund works because it trusts that the market as a whole has priced stocks more or less correctly. But who sets those prices? Well, active investors do. They're the ones digging into company reports, analyzing industries, and making bets on what a company is worth. So here's the paradox. If all those smart, active people give up and just buy the index, who's left to do the hard work of pricing everything? Who's minding the store? There's a classic joke that explains this perfectly. A finance professor, a true believer in efficient markets, is walking with a student. They see a $100 bill just sitting on the ground. The professor just scoffs and says, "Don't bother picking it up. If it were a real $100 bill, someone would have already taken it." And he just walks on, totally confident in his theory. The student, being a little more practical, just shrugs, bends down, and pockets the cash. And that right there, that's the real moral of the story for the stock market. The chance to find one of those $100 bills on the sidewalk, a mispriced stock, that's the exact reason thousands of super smart professionals get up every morning to hunt for them. That profit motive is what keeps the whole system honest and makes sure those opportunities don't last long. So you can almost think of the market as this big ecosystem with two different kinds of animals. First, you have the hunters, the active managers. Their job is price discovery, hunting for those $100 bills. It's tough, time-consuming work, and they charge really high fees for it. And then you have the grazers, the index investors. They just kind of wander through the field, accepting the prices set by the hunters and benefiting from the market's growth, all for an extremely low cost. In economics, there's a term for this: free rider. It sounds kind of bad, right? Like you're getting something for nothing? But here's the key insight. In this case, free riding isn't some flaw in the system. It's actually a core feature. We all free ride on the market's hard work every single day.
So, is indexing actually destroying the market? Well, the evidence actually points in the exact opposite direction. The desire for profit is so powerful that you only need a small sliver of investors to be active hunters, maybe 5 or 10%, to keep the whole market honest, and that's still trillions of dollars chasing after those $100 bills. In fact, most of the data shows that it's gotten even harder for active managers to beat the market as indexing has grown, which suggests the market is actually getting more efficient, not less.
Okay, so that first argument about market efficiency, it kind of falls apart when you really look at it. But that brings us to the second, and maybe even scarier accusation, that by piling into index funds, we are accidentally creating a dangerous concentration of power and handing control of the entire economy to just a few giant firms. And when people talk about this concentration of power, they are talking about these three names: BlackRock, Vanguard, and State Street. Because they run the biggest index funds, they have become, together, the largest shareholder in basically every major American company. Think about it. They own a massive slice of Coca-Cola and also of Pepsi, a huge slice of Ford and also of GM. And this leads to the nightmare scenario. If the same small group of owners controls all the major airlines, wouldn't they be tempted to go to every CEO and say, "Hey guys, stop fighting so much on price, just raise your ticket costs"? It's a terrifying thought, right? That these supposedly passive giants could become active colluders, secretly organizing cartels across entire industries. But this fear completely overlooks how an index fund actually works. Think it through. Sure, forcing airlines to jack up prices would make their airline stocks more valuable. That's the benefit. But remember, Vanguard and BlackRock don't just own the airlines. They own the entire economy. Higher airfare would hurt the thousands of other companies in their portfolios that need their employees to travel. As you can see, the verdict is clear. They'd be causing widespread damage to most of their holdings just for a tiny gain in one sector. It's just plain bad business for them. And hey, we don't have to just rely on theory here. Burton Malkiel, who wrote the book we're drawing from, was actually a director at Vanguard for decades. And he says flat out that in all his years there, he never, not once, saw a vote cast that was designed to hurt competition. Their entire business model is to own the whole haystack, not to pick the winning needles. So with both of those big, scary attacks pretty much dismantled, where does that leave us? What does all of this mean for the average person who's just trying to save for retirement or build a better future? While the case for indexing is as strong as it's ever been, it's been a massive, spectacular win for regular people. The fierce competition between these firms has driven fees down to practically zero. It's made investing democratic, allowing anyone to own a broadly diversified portfolio, something that used to be a luxury for only the very wealthy. And maybe most importantly, it has made the whole process of saving for the long term so much simpler for millions of people. So the final verdict here is pretty darn clear. Far from being some kind of Marxist threat, index funds represent an unambiguous benefit for society. They are a democratic, incredibly low-cost, and powerful tool that has fundamentally changed investing for the better. The rise of the index fund was the defining financial revolution of the last half-century. It completely changed who gets to build wealth and how they do it. And that just leaves us with one final fascinating question to think about. What's the next big idea? What innovation is going to come along and define the next 50 years?